Tonight India time, of course, for the Federal Reserve to come and cut rates. Should they front load all of it up? Would that even be a good idea? I mean, some of that needs to be coming. Just to that point, Niraj, I don't think Jerome Powell is suddenly realizing that everyone's hacking onto his words. He's very, very aware, and I think a cool cat when it comes to handling that pressure.
Yeah,
but,
most certainly.
But Mr. Powell's personality aside, the fact is that the world is in wait and watch mode. I mean, look at U.S. markets overnight as well. Mixed bag on Wall Street, down mildly down in the session. But otherwise, okay, Nasdaq also flat. No big movements, and that's not surprising at all, considering that everyone's wondering what's happening, 25 or 50. Will there be disappointment if there is only a 25 basis cut? Remains to be seen. But the fact is, even if it's 25 basis points, it will be historical. It will be historical because it will be the first time since March 2022 that the Fed would be reversing its rate cycle. Remember, it's been increasing rates or keeping on pause since March 2022 as a response to the pandemic, etc. And this would be the first hint or the first step of reversal. And after that, of course, it continues. How much, how long, how many times will there be a rate cut? Then other questions that follow. One piece of data that came in yesterday will definitely cheer the mood. But in the sense, it points to a more resilient economy than expected and then reduces the cause for a 50 basis point rate cut. In the sense, the Fed need not press the panic button. If you look at the August retail sales data, the expectation was that there would be a 0.2% decline in August retail sales in the US month on month, but instead there was an increase of 0.1%. So that's in positive trajectory, so to speak. So like I said, the Fed need not then press the panic button. Does that make a case for a 25 basis point cut is the question. But commodities and asset classes across the board responding. Look at crude trending upwards. It's not just that hurricane in the Gulf of Mexico, but also because if there's a rate cut, you expect demand to increase and hence demand for crude to increase. Brent now nearing the $74 per barrel mark. Why just crude? Even Bitcoin and all of those cryptos at a month highs because of this Fed rate cut optimism. Let's look at how Asia has opened up. It's a bit of a mixed bag. On open, Nikkei at least in the positive. And overall, you have Nikkei, of course, coming back from the hit it took yesterday, but overall, Asia is not looking too bad. The implied open on the Nifty, will quickly pull that up as well before we get to our conversation on what to expect or what are the kind of expectations baked in. And Nifty also looking like it's set for a positive start, not massively, of course. Cautiousness is the name of the game. But yes, at least trending upwards. Peter Maguire is joining us. He's CEO XM Australia on the show. Peter, great to speak with you once again. Very good morning, at least from where we are. And just to get a sense from you on whether it's going to be a very, very big deal and a big disappointment if we have just a 25 basis point rate cut.
Well, that's a big question, Tamanna. Good morning. Greetings from Sydney. I'll tell you what. I feel as though that that's a toss of the coin, and that seems to be general consensus at the moment. It's about a 50-50 play. We're even hearing the likes of Elizabeth Warren saying, do we need 75 basis points? So let maybe park that to the right. But yes, I think the market's going to be an each way bet. There's I think a strong support for 50 to front load this as far as how many basis points you want to achieve by end of year cut. But there's still many market analysts suggesting that 25 is going to be the pathway forward. So, yeah, we haven't got long to wait, and it'll be interesting to see what the result will be.
I still trying to understand if it's only 25, forget the 75, if the base case is 50 and if it's 25, do risk assets take a dip even if it's only for a short term?
Well, Niraj, maybe they could take a little bit of a dip because it may not meet what the expectation was from traders. You've got to look at volatility over the last couple of weeks and where the market's been really demonstrating that from a vol play. And you've also got to appreciate that US equities are at all-time highs, and pretty much so across, if you look at the Nasdaq, the S&P and the Dow. So I wouldn't be surprised to give a little bit of hot steam. We've just got to see, again, market reaction and the value of, naturally, the US dollar if you see a further sell-off as far as US dollar index and what that's going to do to cross rates and the likes of commodities.
Peter, just talking about commodities, and I'll come to crude first. So crude has been trending upwards, of course, pulling back from its lowest levels. And then you again have the output increase that is expected in December. Where are you seeing crude rates settling? And will a 50 basis point cut set the stage for a further bounce up for crude?
Well, a couple of things. First off, Tamanna, maybe it might see a bit, because I feel as though that it was probably oversold. It did hit that nearly to 67 for WTI. You're running in the best part of over $71 a barrel as of today, or there's a screen, $70.86. So I wouldn't be surprised to see it maybe bounce a little bit further to the upside. As far as demand picture leading into winter, if you do see a back off as far as interest rates, then that could be a telltale sign. We've also got, as far as energy prices in the States, they're well off their highs of what they were experiencing over the last year, though they're still relatively chunky compared to where they were, putting back to, say, 2020. So there seems to be the consideration. If you haven't got any geopolitical hotspots over the next couple of months and weather outages, then you might see crude, be range bound. But if you add both of those scenarios in, that could change the landscape considerably.
Peter, one final question. Today, Goldman has revised the iron ore outlook downwards. Industrial metals are anyways taking it on the chin because of China and the growth not bouncing back. Where are you on this argument? Do you foresee the rest of the year to have a protracted downtick or a continuation of this somber performance at the industrial metals front, be it iron ore, be it aluminum or others?
Well, Niraj, I think, if you're looking at copper at the moment, and that's a good barometer, since it's trading at around about 9,300, I've got on my screen here, 93.70 a metric ton for on the LME. I wouldn't be surprised for them to probably oscillate where they are at the moment. I think from a range-bound perspective, you might see a low of 86, 8,700 up to, say, 94, 9,500. So it's going to be range-bound. You've only got to look at that, I suppose, forecast from an iron ore perspective, and that's pretty bleak at $85 a tonne. But it's the price is the price, and that seems to be the general consensus out there. That's the consideration as far as how China's positioning itself, and they're the major importer. So we've just got to see. Global demand has got to pick up for finished goods, and this could be the turn of the season as far as interest rates dropping and a time for 2025 to be a little bit more global growth. Okay.
Peter, we'll leave it at that. Thanks so much for joining in, and all the best for the big Fed meet. Viewers, this is the biggest thing. Now, for everybody knows this, but I'm just reiterating a couple of other nuances out here. So the Fed meet begins today. The market, like we said yesterday, but I'm reiterating again, is currently pricing in a 62% possibility of a 50 basis points rate cut. Remember, the probability was 25% a month back. This is as per the CME Group's Fed Watch tool. Now, the question is, what happens if we get only 25 basis points? Because, remember, official figures earlier in the day in the US, effectively, because they're still in the night, official figures earlier had shown that the US retail sales in August were a lot stronger than anticipated. And the US financial conditions, as per Goldman Sachs, are the loosest since April 2022. So the economy is not as bad that it warrants a sudden large drop down from the Fed. That is one assumption that people are making. And the fact that the financial conditions are not also so tight that it warrants a steep rate cut as well. So fundamentally, as per a lot of global houses, it's okay if the Fed does only 25 basis points. But the other question, therefore, is independent of whether it's 25 or 50, because Peter has spoken about this, what happens to EMs, in particular the Asian markets, if indeed we get a rate cut, and it seems to be a given. So there is something called as a Z score, a real policy rate Z score. Let me tell you what the Z score is and is currently, and then I'll tell you what's the significance of this Z score. So the real policy rate Z score for Asia, so India is 2.1, Indonesia is 1.8, Philippines 1.5, Thailand 0.9. Now just remember these numbers and then understand what the Z score is. So the Z score refers to the standard deviation of the current real rate, right? Nominal rate minus inflation, real rate relative to the 5-year average. Simply put, the last line matters. A higher Z-score means higher real rates. And since India's real rates are higher, the probability or the possibility or the room for India to cut rates relative to a lot of other markets is also therefore higher. And therefore, it could be very interesting to see that when that happens, what happens to emerging market equities and debt. And Tamanna, Amundi in an interview to Bloomberg had said that the real rates across the whole Southeast Asian economies higher than a year ago, which suggests room to ease, a situation likely to benefit the local bond markets. Add to that, we are in the emerging market indices for JP Morgan and some of the others soon. Fixed income in India might be a really interesting space to watch over the course of the next 6 months.
Yeah, and while we're obsessing about the Fed rate, remember it sets the stage for rate cuts for us as well. But just having said that, one point, Niraj, and since you explained this so well on interest rates across Southeast Asia, at least India has typically always had a higher real interest rate. Our regime is like that. We're comfortable like that. Inflation tolerance, I would say, is relatively higher. So all things considered, the decision making and the thought process might be a little different to what we're seeing. What a Shaktikanta Das might take into consideration might be a little different from what a Jerome Powell says.
Most certainly. But could it make the fixed income space though interesting? I think it's a key thing. For a long time, it's been equities. Does the Tina factor move away? It's a key question.
I don't know. I would bet that equities. And look at the craze for IPOs, for example. The kind of interest in equity is not going anywhere soon. Anyway, let's look at what fund flows were like yesterday. Remember, it was a sort of stagnant, I wouldn't say stagnant, but a quiet kind of a day yesterday. And fund flows were decent in the positive on both sides, but not massive in volumes. And you'd likely see that till you have clarity. That should continue. One more look at the implied open before we get to the trade setup for the day and a bit of a recap of what we saw yesterday. 18 points up. Remember, yesterday was not a massive kind of a day. Autos, at least two-wheelers, were beginning to rev up towards the close of trade. So you had Hero as one of your top gainers. That did fairly well, likes of TVS, Bajaj, etc., all doing well. I don't know how Bajaj will fare today because there's some notes out which are raising concerns on valuations, etc. So that is one to look at. But Tata Motors was the big loser yesterday. Bajaj up 2.5% yesterday, but Tata Motors was one of the big losers yesterday. So I'd watch out for autos. And of course, oil companies, which I'll come to in a bit as well. Those will also be on radar today.
Yeah, most certainly. So a lot of individual pockets. I mean, frankly, so the trade setup, cautious stance maintained ahead of the FOMC meet yesterday. Look at volatility. India VIX really came off at 12.59. We are trading at the lowest point of the month for India Volatility Index, and therefore stock-specific movement, maybe oil and gas and sector-specific movements possible, but very likely that large leverage trades on the index will not be a case. You will probably see call writing and put writing both happening. But large leverage trades on the futures side, I would believe is going to be very, very difficult. The heartening piece, though, Tamanna, I mean, the disheartening piece was, it's a fly in the ointment, if you will, but temporary. That surge in gold imports to a record level drove the deficit higher. But the heartening piece was this, that Jonathan Garner and team wrote out the EM equity strategy just ahead of the Fed, and they are saying that we think India will continue to gain share due to market outperformance, new issuances, and liquidity improvements. This is on the MSCI EM weightage. And they remain, he says that we remain overweight India and underweight China in our pan-Asia emerging market asset allocation strategy. So this is none less than Jonathan Garner saying, and therefore assumes significance for sure.
Okay, so in that sense, the outlook for India is positive. And remember, we are talking about just the first 100 days so far of the Modi 3.0 government. So actual capex has not even come in yet. So wait for that, hold for that, and then you will perhaps see even a bigger boost to some categories of the equity markets. But meanwhile, let's get from the macro and the overview to the stocks that you should watch today. So let's get down to business. Let's start with ONGC and Oil India. This on my radar first. A thumbs up for this. simply because the move last evening from the government is quite astonishing. The government has reduced windfall tax on crude oil to 0 from 1,850 rupees per ton. This is the only second time they've done that since the start of the windfall tax regime. Remember, the windfall tax is there because it's an extra excise duty on companies, on oil marketing companies, so that you make sure they don't have excess gains, especially when crude rates really go higher. Now, the previous tax, like I said, was 1850. They've been reduced due to falling crude prices. Brent has been down 15% since July this year, and it's the only second time since the introduction that they have done this. So positive for Oil India, for ONGC. Remember, it gets reviewed every 15 days, this tax. So it actually becomes positive on their balance sheet if crude prices continue to trend upwards. And considering that a Fed cut will boost crude prices upwards, you could hit the $75 mark on Brent. This could actually be pretty positive for both these companies. So that's one to watch out for. Torrent Power, another thumbs up for this stock as well. They've received a letter from Maharashtra Discom for a 1,500 megawatt pumped hydro storage project. It's a 40-year contract, and they intend to commission 100 gigawatt of capacity by 2030. This is the second day in a row. Big order being announced for Torrent Power. Watch out for that. Jupiter Wagons will be in focus, and I reckon a few of the other rail stocks as well. For Jupiter specifically, they're expanding their capacity from about 20,000 forged wheel sets to 100,000 forged wheel sets per annum. They will be putting in an investment of about 2,500 crores odd. But remember, and this out in a press note yesterday, rail capacity on rail capex is also in focus, and the finance minister has reviewed this as well. So 434 railway projects have been identified under the PM Gati Shakti corridors. 11.16 lakh crore rupee investment will be coming in. There will be focus on safety, capacity and convenience. 40,000 rail bogies to be converted to Vande Bharat standards. The Kavach system will be operationalized on a 108-kilometer track as well, and rail track electrification will be expedited as per budget capex. So nothing extra coming in there. But overall, the fact that 11.16 lakh crore investment has also been announced could be a boost for a sector which has otherwise been languishing for a bit. The rail story just sort of evaporated. Maybe this gives it a bit of a nudge today.
Yeah, it could be a very interesting one. And across the value chain, comments there. So I think it could be a very, very interesting piece for sure. Not too many stocks in news, viewers, but I thought Seagal also stood out in addition to the ones that Tamanna has pointed. So for a company of its size, L1 for 2 orders, one of them for 1199 crores and one of them for 1299 crores. Could be interesting, might bring out a bit of a reaction in the stock, so do keep an eye out for this one. Just wanted to spend a minute on the SKF demerger because it's a global demerger. Now, the backdrop is that auto for SKF Global is a smaller part of the consolidated business and is a lower margin business, 5 to 6%. The industrial business margins are at 16 to 18% being spun off to unlock value. This is at a global level. Now, when you look at this announcement impact on SKF India, there is no impact on the India business. Frankly, people who attended the call yesterday mentioned this, that in the whole call, there was not a single comment on the India business. This was at 7 p.m. IST, conducted by the SKF CEO and CFO. And the split between India is slightly different, wherein 60% is industrial, 40% automotive. But I think the only thing is that if SKF Global is thinking of demerging these businesses and thinking of improved capital allocation, could that at some point of time lead to this improved capital allocation strategy across all their businesses, and therefore could India also see something like that happen? Now, the street will think about it that way, logical to think about it that way too. So maybe that's how it will happen. But as of now, there is no direct demerger happening in India. Keep that in mind. The demerger that is happening at SKF Global. So that's the second stock on my radar. And the third one, Tamanna, interesting one. I don't have graphics for it, but I'll just mention it. That is the brokerage note from Macquarie on TCS. Now, we know IT has been blowing hot and blowing cold, but Macquarie says TCS is growing faster than Infosys in spending rebounds. Their analysis, of course, suggests this, and their target price is now. They believe TCS is better positioned than Infosys because they expect more cloud migration deals to be bundled between applications and infrastructure services, and they see TCS as a better position one than Infosys on this. And their 12-month target price is 5,740, which is about a 29% upside to the current market price. So it could be interesting to see TCS today.
Wow, TCS in action. I mean, all of IT will be in focus basis the rate cut news coming out of the US as well. Just one more brokerage note, because I think these are the two big ones today, and the CLSA one on Bajaj Auto is quite dramatic, for lack of a better word. They've retained an underperform with a target price of 7,000 rupees on a stock which is 11,950 right now. So that's a downside of 40% on Bajaj Auto. Remember, they launched, they had a launch of Triumph yesterday as well. So they say Bajaj and Triumph launched two motorcycles positioned as entry-level motorcycles. The Speed T4 hits the right spot with attractive pricing. They delivered 60,000 Triumph bikes in FY24. But, and here's where the but comes in, they remain cautious on the increasing competitive intensity in the premium motorcycle space. Remember, TVS also launched a premium motorbike a couple of days ago. They say growth moderation in the larger than 250cc motorcycle segment is growing slower than over motorcycle industry, and there's continued pressure in export markets. The volume run rate has not changed much since the launch of the first Triumph bike. And of course, there is always that little niggling concern about valuation. So Bajaj Auto in focus. Remember, it's all been love only for two-wheelers. Will Bajaj Auto see a bit of drubbing today is the question. But, just moving a second away from the specific stocks to what we've been seeing. So technically and officially, the third term of the Modi government finishes 100 days tomorrow, if you take it from the date of the swearing-in ceremony. You've already been hearing a slew of conversations here on the NDTV network with top ministers on what they have achieved in the first 100 days, but of course, what the plan is from here on. We thought this is a good time to take a look at how markets have behaved in the first 100 days of the Modi 3.0 term. And Rucha is joining us for all the data on that. Rucha.
Thanks, Tamanna. As you rightly mentioned, the first set of 100 days for Modi 3.0 is here, and we'll start by having a look at the performance of indices. We'll start by having a look at Sensex and Nifty. Well, Nifty is up about around 9%, and Sensex rose about 8.5%. That is 6,600 points in just about 100 days. But then moving on to having a look at sectoral gainers, we largely have defensive name. If we can move to the next slide, we largely see the defensive names like Nifty IT, Nifty Pharma and FMCG, the top sectoral gainers, were Nifty IT gaining about 23% and Pharma by about 20%, and FMCG a tad lower by about 11.5%. But the top losing sectors, we largely have the PSU Bank losing about 8.5%, followed by metals and realty. Realty is almost flat by about 0.3%, losing about 0.3%, and metal losing about 5% in these 100 days. But then if we move on to having a look at the stocks, the Nifty 50 gaining stocks, we largely have the finance and IT names over here. Shriram Finance, SBI Life is what gained about 37 and 27% respectively, but IT names as well. IT as the index rose about 25%. LTI Mindtree was the top gaining stock, about 30% up in those 100 days, followed by the big IT major Infosys. But then we'll move on to having a look at the losers of the Nifty 50 index. We largely have the steel, metals and mining name like Tata Steel, Adani Enterprises losing about 14 and 7% respectively. SBI, another finance name over here, is a little bit of surprising to having a look at SBI losing about 6%, and auto names also didn't do well, with Maruti losing about 4% and even M&M losing about that around 4 to 5% in the trade. But we'll have a broader look at market, and we'll have a look at Nifty 500 gainers, to give us a little bit of a wider perspective. We have PCBL, which is in the carbon black industry, rose about 112 points in trade in these 100 days. So this is huge, largely the mid and small cap index over here. We have Suven Pharma, Himadri, chemical names over here gaining about 87, 78, all more than about 50 to 60% over here. But also we'll have a look at the Nifty 50 losers to give us a wider perspective. Again, a mix of sectors over here is what we can see. Hindustan Zinc, IRB, Infra, Adani losing about 20 to 28% in trade. And we have Vodafone Idea. Now this one has been doing really volatile since last couple of months around the back of its issue, and brokerage houses, Goldman Sachs, which came about a note implying about a 50% downside. Vodafone Idea losing about 17% in these 100 days. So, Tamanna, this was a broad perspective on the sectors and the stock performers as well. But we'll see whether this will maintain its stance in the coming year as well.
Okay, thank you for that, Rucha. Now, just to put that in a little bit of context, the first 100 days of any and all governments, including the last two iterations of the Modi government and the UPA governments before that, are somewhat of a honeymoon period as far as the markets are concerned. Remember, that's also because you have one big event coming in there, which is the budget, the first budget which comes in after that election cycle. So that's generally seen as positive. You see a positive news flow there as well. Not quite in Modi 2.0 there. There you saw a little bit of a tepid response because you'd seen a massive run up in the markets before the election itself. So in that sense, it's par for the course, but good perspective to have. Also, more focus on government spends and policy this morning. Finance Minister Nirmala Sitharaman has reviewed the capex plan of the Railway Ministry and called for better safety and convenience of commuters. This in addition to identifying 434 projects under the PM Gati Shakti corridors. Mahima is joining us with all the details and the possible movers, Mahima, in the rail space, which has otherwise been quite quiet.
Absolutely. So railway stocks which have actually seen a significant runway in 2023 have remained silent in 2024 so far. So Nirmala Sitharaman has reviewed the railways capex and she's urged to focus on safety, capacity and convenience, as you rightly mentioned, and she's identified roughly 434 railway projects under PM Gati Shakti, and this will overall involve an investment of 11.16 lakh crore. They're also set to expedite 40,000 rail bogies to be converted to Vande Bharat standards, and Kavach system will be operationalized on a 108 kilometer Kota Savai Madhapur section, and this will happen at a 54 kilometer per month pace. They've also said that they'll expedite the railway track electrification and doubling as per the budgeted capex, and it's set to appraise 101 projects under economic corridor programs in 2024. Now, possible stock movers on the back of this could include Ircon International, IRCTC, BEML, Concor, IRFC, Railtail Corp, Titagarh Wagons, Texmaco Rail, Jupiter Wagons, Rights, and RVNL, and some companies that are into Kavach systems, which include Karnex Microsystems and HPL Power Systems. So these stocks could be on the radar in trade today on the back of the entire announcement.
Okay, so rail capex in focus. You of course have the first 100 days and all of the announcements there in focus. Thank you for that, Mahima. And Niraj, I think this is a trend that we're going to see for the next few months. We've already seen it. So states with their allocations of mega projects. We've seen them in renewable energy, hydro, solar, Torrent Power, Adani Green from Maharashtra government last couple of days. You will see capex allocations increase across sectors. You've seen the defense players come up again, right? So Ministry of Defense coming out with its orders and the companies that are benefiting from it. So more of the same once the 100-day mark is over is what I would say.
Yeah. And the other interesting piece is, Tamanna, that we are hitting a season of peak festive buying, which is something that you alluded to. So it'll be very interesting to see. Wedding season as well, such peak wedding season coming up, aside of festive buying as well. So what happens to gold imports as a result of this? Are we seeing more records? Yeah,
and gold imports have already been a bit of a difficulty. We spoke briefly about the trade data, but look at what Nomura is saying. On the trade data which came in yesterday, they say trade deficit has taken flight in August amidst a turbulence in exports, higher gold imports and weak exports have widened the trade deficit. So in that sense, not the best outcome when it comes to India. The services trade surplus, in fact, has increased to a 7-month high of US $15 billion in August from 12.9 billion USD in July. In terms of exports, the trade deficit rose to $26.1 billion in August from $24.3 billion in July. Electronics and engineering goods continued to post stable growth. Labor-intensive sectors such as textiles and gems and jewelry, though, are underperforming. Remember, that's also a function of global appetite, so that should be kept in mind. Export volume growth has been tepid, with most of the rise driven by price effects. But on the import side, import growth has actually moderated year on year in August to 3.3% from 7.5% in July. Oil imports dropped sharply. It's also a function of oil prices, good for us, but look at the appetite for gold and exactly what you were saying, Niraj. 104% surge in gold imports year on year. And now, I'm wondering, in terms of a broader implication, this widening is unlikely to be sustained because external demand will continue to be a downside risk. But I'm thinking in terms of impact for some of your gold players in the market, which have already been very, very excitable, shining. Your new listing, PN Gadgil, yesterday, you'll see a bit more of that.
Yeah. Customs duty cut, more imports, more frenzy for gold, festive season, weddings. It all augurs well. I mean, Manav Chopra of Nuama mentioned that he sees Titan gaining about 50% the next 1 year. We've seen what's happened to Kalyan Jewellers, wherein the promoter bought in a block deal as well. So quite significant really what's happening there. Actually, let's focus on the derivative space, and Akshay P. Bhagwat, Senior VP JM Financial, joins in. Akshay, good having you. Thanks for joining in. Good morning to you. Before we get to strategies and FNO specifically, me and Tamanna were talking about gold imports and the kind of frenzy that we've seen in specific jewelry names. Now, there is a Kalyan, there is a Titan, Senko, etc. How do you analyze those? Then we'll come to the FNO space, but just a brief question here.
Yeah, good morning to all. First of all, the momentum in the gold companies, these were ahead because of the IPO which came a few days back, and it was more of a sentimental momentum for these companies. And somewhere, if you look at the overall build-up in terms of the futures and options space, where Titan has the exposure to, a lot of long additions have been very much seen in this counter since last 10 to 15 trading sessions. So an extremely positive setup here for Titan. Even as a matter of fact, if you look at the gold financing companies like Manappuram Finance or Muthoot Finance, technically they are very strongly placed on the price charts. So there is more to go. It is just that there has been a short momentum break for the last 3-4 trading sessions. But I believe the momentum should regain soon, and you will have still more upsides or more room for upsides in these counters in the days to come.
Akshay, morning. Tamanna here. I mean, for traders, this would be a very, very cautious kind of a day. Obviously, you have Bank Nifty expiry today. You have Nifty expiry tomorrow, and Mr. Powell in the middle of those two events. So with that decision pending, let me just get your call on the Bank Nifty and what would be your strategy there. Can you expect the expiry to be within 52,000 to 52,500?
Yeah. Good morning, Tamanna. Well, yes, all eyes on the Fed event. And if you actually see the muted action in the last couple of days, Nifty has been laggard, and even the Bank Nifty, as a matter of fact, though it's inching up gradually, the momentum clearly is lacking on an intraday front. Expiries have been very dull. Mid-cap Nifty went up yesterday. And I believe the same sequence is likely to unfold in the Bank Nifty as well for today's weekly expiry. If I were to see the derivative side of positioning for today's weekly expiry in Bank Nifty, it is the 52,000 strike in put, which draws the highest open interest. So a lot of put writers have positioned themselves on the expectation that the expiry should be at or around the 52,000 mark. And on the upside, it is the 52,500 strike in call. My sense is that looking at the broader technical parameters, the derivatives placement, expiry may be at or around 52,000 plus minus 100 odd points. So do not see much of an upside for today. It's a cap on the upside. It's more of a day which would favor the option writers. And maybe a slight downside or a consolidation should see the Bank Nifty expire around 52,000. That's the expectation I have for today's weekly expire.
52,000 is the expectation on a bit on the downside for the Bank Nifty. What about the Nifty, Akshay? Expiry tomorrow, but what are the two scenarios playing out? 25 basis point rate cut and 50 basis point rate cut.
Oh, yes, that's how the positions are setting up, whether it's 25 basis or 50 basis points. And overall, if you look at the positioning in the market ahead of the event, well, the position is extremely strong. You have an OIPCR in the derivatives option segment, which is around 1.10. So clearly the put writers are having an edge over the call writers. 25,200, 25,300, these are the strikes and puts which are picking up writing action in the last couple of days. Technically also it is a strong setup. It is just that the markets are going on a back foot ahead of the event. So today's trading session also may be light on volumes, but broadly looking at the positioning in the market, well, the upside resistance or if there's a 50 basis point, you can expect around 25,700 to 750. That obviously will come in form of a gap up. But if things move on the expected lines, that's if there's a 25 basis rate cut, then you can expect some bit of mild profit booking, which can drag the Nifty down to the levels of 25,200. So that's just a temporary short-term move. Do not see much of a price damage in terms of the broader chart structure. Till 24,900 holds, the entire setup for the September series is strong, and you can continue to hold your long bets. Buy on dips if the market tomorrow gives an opportunity to enter around the levels of 25,000, 25,100. That's the recommendation I have for the Nifty index.
Now some option strategies, viewers, and Akshay, you have a bull call spread on Hero Moto. Why? It's an active stock, was doing very well yesterday. Why this particular strategy?
From the entire auto space, if you look at the price setup in Hero MotoCorp, there was a technical breakout in this counter yesterday. The breakout was at the level of 5760. The breakout was at the swing high of 18th of June, which did see a strong resistance in Hero MotoCorp. So you had strong volumes and derivatives long additions in this stock. So my expectation is that for the next 8 to 10 trading sessions for the expiry, you can expect a positive momentum gain, and one of the best technical setup in the auto space is of Hero MotoCorp as it goes right now. Expecting levels of around 6,100 plus, for which I am setting up a bull call spread where my risk is limited and also my return would be under control in case something would go wrong. So the bull call spread is where I buy a 5,900 slightly in the money call at a premium of 150 odd rupees. Sell an OTM call of 6,100 strike, which was quoting around 57 as it closed yesterday. I'm expecting a profit potential of around 9,200, and as a risk management, you can have a stop loss of rupees 5,700.
So you are effectively saying, Akshay, that you are doing this spread because you wanting to protect downside risks in the event of a market pullback.
Yes.
Got it. Okay. Is that the reason why you're also using options to play DLF? Because that is one another real estate stock that has been on a bit of a roll.
Exactly. But if you look at the option strategy for DLF, I am comfortable in buying a vanilla call option for the October series. Now, the reason is that we are drawing to the end of the September series expiry, and time is the most important ingredient here, because everything is dependent on how the stock moves as per the time value in the next 7 to 8 trading sessions. So even a couple of days of stagnant move can see a huge depreciation in option premiums. So to not get into that risk element, I'm playing for DLF, where I have an extremely positive view for the next 10 to 15 trading sessions. I'm expecting targets of around 920. This may happen probably by the first week of the October series. So I would prefer buying a 31st October expiry vanilla buy call in DLF of the strike 900, which closed around 20. So buy it in the range of 20 to 17. We'll get it in today's trade. And you target effectively 37. That's your first target, and 51. So it can be a potential doubler for you if the view works out well. And the stop loss on this strategy would be 10 rupees and the option premium.
Okay. Akshay, thanks so much for joining in today and giving us your thoughts. Really appreciate your time. And viewers, I hope these option strategies help you. Remember, some of them are placed in a way that the analyst is constructive, but he's using options to mitigate the risks in the event of a pullback. Akshay, our guest today, likes both Hero and DLF on the charts, but he's using options to mitigate the downside risk, if any, that may come in. Interesting strategies, though, particularly on Hero, Tamanna, because that stock was on a roll in trade yesterday.
Hero is going to be in focus today as well, and especially if there's a downside on Bajaj Auto, you might see Hero revving up a bit. I mean, all of those, at least in the EV side of it, two-wheelers have been in focus. Look at Ola Electric yesterday on the back of those two notes, Goldman Sachs and BofA. Bajaj today because of basically a bit of concern on the premium segment play and the Triumph kind of a play, but Ola Electric on complete fire yesterday, 9.5% up on that stock eventually. TVS didn't do too well, but Hero definitely will be in focus. But so will oil companies, because in a move that can earn the burden on common man's pocket in near term, government has decided to slash windfall tax on crude oil to zero. Mehika joins us to tell us more. Mehika, start by telling us, of course, you tell us the potential beneficiaries. How is it going to ease the burden on our pocket?
Yeah. So, windfall taxes were first, imposed to curb the excess profits that oil companies were making during periods of rising crude prices. But currently, crude prices have seen a negative trajectory, which is why the government has reduced the windfall tax on crude oil, and it's reduced to 0 per ton, and the previous rate was 1,850 rupees per ton. And this new rate is effective today itself. Now, windfall taxes, like I said, is a special additional excise duty, and the tax has been reduced right now due to the declining crude prices. When crude prices are down 15% since July 2024, trading around $73 per barrel. This tax was first introduced in July 1st of 2022, and this is the second time the government has slashed the tax rate to zero. Now, on the back of this, we could see some sentimental uptick in the stock prices of ONGC and Oil India, because these two are the major companies that windfall taxes are imposed on, and lower windfall taxes are a positive for ONGC as well as Oil India. Another aspect of it is right now crude prices are trading below $75 per barrel. There's no direct financial impact on the balance sheets of ONGC and Oil India, but just in case the crude prices do see an uptick about $75 per barrel. Previously, when the windfall taxes were about the level of zero, the company's realizations, that is the revenues per barrel sold, were limited at $75 per barrel. So in case we see the crude price uptick for the rest of the month, the companies could see higher profits on their sales revenues.
Okay, thank you for that, Mehika. So net, there is no faida to you and me. That will come though before the state election dates are announced, because there is enough room now, and there's so many calculations out there, Niraj. Some up to 8 to 10 rupees a litre for petrol at the pump, because those excise duty cuts have not taken place, even though crude prices have come down significantly. So maybe we have to wait a bit ahead of festive season, maybe election dates for key
Or buy an
states.
EV so that these things don't bother you.
Oh, but what about the extra premium you have to pay for it?
Do your bit for the environment.
Yeah, this
and for your feel good of the running.
This is a great conversation to have at some point about EV or not EV. Is the premium worth it? What about the charging stations? Have we reached that tipping point? But that's for another day. For now, let's talk about the watch list that we have on NDTV Profit this morning. First, the ones that could do well. We already spoke about ONGC and Oil India, but let's add to that list SKF India. They are separating their global auto ops. That could be seen as a positive. Seagull India, definitely. They've bagged an Ayodhya bypass project, a couple of them actually. In terms of REC, they have 1.12 lakh crore non-binding MOUs. So essentially new orders coming in.
Yep. Let's move on to the next set. Hindalco plans a solar module manufacturing unit, so could be interesting to watch today. Torrent Power, amidst all the commitments that they are doing, are also bagging orders, has won a 1500 megawatt hydro project from Maharashtra, so could be in focus today. Vakrangi, well, Star Health sale plus fundraise. Let's see, it's a difficult stock to talk about usually. Who knows, may react a bit today.
Also, Ratan India, Revolt has launched a new RV1 e-bike. We've actually done an interview with them. Our colleague Rishabh attended the launch yesterday, and we'll see if we can play out that interview on that e-bike. IHCL has a new resort coming up at Barnala, and TCS has an outperform rating from Macquarie. So those are definitely some of the stocks which are on focus today.
Yeah, and the couple of which may also be in addition to what Tamanna said about ONGC, Oil India and the upstream oil, could be stocks like Inox Wind, which has got an LOI from IGREL Renewables for execution of 550 megawatt wind capacity on a turnkey basis. Large one for Inox's size, much smaller company relative to Suzlon, and therefore could be an interesting one to focus on. But I tell you what, everybody's focusing on, and that is, Tamanna, this before we get to Kush and Avinash, this whole social media thing and the message floating on WhatsApp as well, pure math, that with this two upticks and circuits that Bajaj Housing Finance has seen, the market capitalization of Bajaj Housing Finance is more than the combined market cap of 10 other housing finance companies. I mean, this is serious premium attached to one stock.
Insane. It's insane. So that's social media is interesting, and equity social media is even more interesting, because even as you have that chart doing the rounds, and yes, you have a huge market cap now to Bajaj Housing Finance, a lot of angst as well at the run up from some quarter, saying that what about the valuations, this is frenzy, this is euphoria. I think a little overstated, because investors are not fools at the end of the day, and you have some marquee names really coming in.
Yeah, I mean, whenever this conversation happens about NBFCs getting premiums, and I'm not saying a Bajaj Housing Finance is a Group Finance. Group Finance, by whatever it did, was in a league of its own with Sudhin Choksi doing the kind of ratios, etc. But consistently traded at 13-14 times price to book. Consistently. Bajaj Finance, for all the fanfare, and it's been a great stock, Bajaj Finance, max price to book has been 9 times. So, well, you don't know what happens to price to adjusted book for Bajaj Housing Finance, but just purely in terms of, so we've seen this tape play out in valuation terms, but just in terms of market cap terms, this is staggering really for Bajaj Housing Finance.
Yeah, question is whether you'll see more of an upside today. Kush Bora joining us, founder kushbora.com. Avinash Gorakshik are also with us. He's Director Research at Profit Mart Securities. Good morning to both of you. And since we're talking about Bajaj Housing Finance and what happens to it on day 3, Avinash, let me start with your take on that.
Yeah, good morning, Tamanna. I think clearly, the kind of valuations we have seen on Bajaj Housing clearly reflects the kind of appetite, both the institutional and retail investors currently have for the company. I think the housing finance market, Tamanna, is a very big opportunity. There's a very strong runway available for the company. And I think the markets are looking at the next 2 to 3 years. I think, if you look at how Bajaj Finance has rewarded its shareholders, I think markets are expecting that Bajaj Housing could also be another opportunity of that sort. And that is why today valuations don't matter. I think, today, despite the fact that, as you mentioned, that, the market capitalization of Bajaj Housing is more than 10 other housing finance company put together, I think markets would also look at the growth quotient. I would not be surprised that over the next, say, 3 years, even at these odd levels, there could be a decent amount of money to be made. The company has a very large, AUM, a very strong runway for growth. So I think ideal investors should obviously look at, accumulating the stock in a small SIP manner. Maybe the stock could also correct. It's not that you see these 10% moves almost every single day. So, this is just the first reaction after the public issue. But you could get opportunities where the stock could average around 150 to 160 odd level. Then that could be the base level. So I think, longer term, yes, the opportunity is large. But in the near term, these volatile moves and these absurd kind of valuations will continue. Markets are now looking clearly at growth. So valuations don't matter. It's a matter of time before, numbers come in. Yes, but it puts a lot of pressure on the management to deliver on the numbers, because, in case there's a slight deceleration in growth, I think the markets would obviously also punish these stocks very badly. So I think you'll have to look at the numbers very closely and how the management delivers going forward.
Well, okay. So that's on Bajaj Housing Finance. Kush Bora may not have too many charts there, so I'll spare him that. But Kush, it'll be interesting to know. Yesterday, you were mentioning that you would take a sidestep on index strategies, and maybe that's a prudent decision fundamentally ahead of the Fed move too. So is that the same case today? Or are you making an exception on any of the indices?
Hi, morning, Niraj. In fact, I'm taking it one step ahead. Let's just probably call this a holiday, a midweek holiday before the big event, because not much needs to be done. I mean, the markets could perhaps still be volatile, given the kind of setup there is, at least on the bank Nifty, where you've got the weekly expiry today. But other than that, I presume that not much for you to do, as a trader, as an investor, just before the big day. So the idea actually here is to stay light. If you have an existing position on any of the indices, not a bad idea to hedge it perhaps, because there has been an inherent strength, at least in the bank Nifty, that we've seen. Nifty continues to remain largely flat, where 25,400, 25,450 seems to be acting as a near-term resistance, quite rightly so. And whereas on the bank Nifty, if you see, we've been having higher high, higher low kind of formation, suggesting an inherent strength. And we've maintained that, right? That Nifty is a no trade at the moment. If you do need to trade in bank Nifty on the long side, but just before the event, if you don't have a position, stay out, let the event pass. We'll see tomorrow how the markets react to it, and then perhaps take a trading position. But today is the day where you stay live.
Kush, I don't know why you're hoping for that it's going to be like a holiday. It's definitely going to be a complete working day for everyone in the market, because Bank Nifty expiry tomorrow. And even if you're sitting on the sidelines, I don't think you can put your feet up quite yet. So having said that, what would be your top picks this morning?
So, I'm not saying it will be like a holiday. I'm actually calling for one. If you're a trader, if you don't have
Ummeed is a different thing. But,
but markets will continue, and the show must go on, as they say, right? So the show will go on. Still, just a quick word on the Bank Nifty because of the expiry. 52,200 to 52,500 calls. There has been a lot of writing we've seen, and 52,000 put has seen a lot of writing. So it could be the range, 52,250 to about 52,000. That's the range where you can see the Bank Nifty expiring. Not a very clear direction, but as I said, if I still have to take a trade, I'll take it on the long side on the Bank Nifty. Now, given the setup, we've got two calls, and it's a hedge once again, one long and one short. Sansera Engineering, this stock has, it's been on a roll. If you see for the last 7 to 8 odd sessions, it had a positive closing of, practically vertical run up. But yesterday too, given everything, how the markets have been, the stock ended higher on the back of good volumes. So I think this trade could continue. Even if there is a minor pullback, I don't think the traders or the investors need to worry on this. Hence, the targets and the stop losses on this one are slightly broader. 1660, 1730 are the targets, 1500 is the stop loss. On the sell side, you've got Petronet LNG. Here we've seen pressure. We are seeing a bit of a dead cross on this one, on the moving averages crossing on the lower side. 335 was a level that it was holding on for the last 4 sessions. Yesterday gave way and closed below it, again on the back of decent volumes. So this down move could continue, plus you'd need a hedge, going into an event. So Petronet LNG looks like a good bet on the downside. 329, 323 are your targets. 339 is a good level to have your stop loss at.
Okay, so that's some of the calls by Kush Bora. Now let's get in a view from Bajaj Auto's Rakesh Sharma about a variety of things, including the new launches. I dare say I would have loved to ask him about the CLSA view on what will happen going ahead as well. But hear out Rakesh Sharma.
आज हमने ये 2 ज़बरदस्त पेशकश की हैं मॉडर्न क्लासिक को एक्सपेंड करने के लिए। जो T4 है वो ईजियर राइडिंग एक्सपीरियंस और मैनेजेबिलिटी के लिए, कि कुछ लोगों को बिल्कुल पावरफुल इंस्टेंट रिस्पांस उस टाइप की बाइक से थोड़ा सा इंटिमिडेटिंग लगता है, उनको ईजियर वो चाहिए। उस कस्टमर सेगमेंट के लिए स्पीड T4 हमने पेश किया। लेकिन ये बाइक में भी अगर आप देखें तो इसका पावर 50% ज़्यादा है बाकी क्लासिक बाइक से, और टॉर्क 33% ज़्यादा है बाकी क्लासिक, और काफ़ी इसमें बाकी सारे फीचर्स हैं, बिल्कुल चार्मिंग स्टाइल, बिल्ड क्वालिटी एटसेट्रा।
Okay, so that was Rakesh Sharma on the Bajaj Auto launch, but what is going to be the situation for Bajaj Auto today is the question, and I'm talking about that CLSA note which has come in, and we'll just review that. A target price of 7,000 rupees is what CLSA is saying on Bajaj Auto. They see a 40% downside, and they've retained an underperform call. because they say that while the two motorcycles have been launched between Bajaj and Triumph, positioned as entry-level motorcycles, and the Speed T4, that's the bike, hits the right spot, but they are cautious on the increasing competitive intensity in the premium motorcycle space, and that's one of the concerns that are coming in. Avinash, just your take on a Bajaj Auto. Do you expect to see a bit of a downside today? The stock has been roaring.
No, I think, Tamanna, my guess is, this is a extremely pessimistic scenario. I think although competitive intensity in the premium bikes has increased, I believe, Bajaj Auto has got a very strong product on the table. Obviously, pricing has been aggressive, and the success of these models will be decided in the coming 3 to 6 months. So I think in the very short term, this kind of aggressive cut, by CLSA may look a little odd, and I would not be surprised that the markets would like to give the company an opportunity to actually deliver on the numbers. I think in the two-wheeler market, Bajaj Auto continues to record healthy volume growth. They have a well-diversified product, bouquet. And I think these new products are going to actually accelerate growth. So I think, at least in the very short term, I don't expect any major negative surprise. In the medium to longer term, that is at least over the next, say, 6 to 8 months, the success of these products is going to be critical. If we don't see any decent volume growth and the market does not welcome these products, then only I would believe that we could see such kind of aggressive downturns in the stock price. But otherwise, I think Bajaj is on a very strong wicket. I think if the stock at all corrects, marginally or moderately today, I think longer term investors should actually use this as a buying opportunity. I'm pretty positive on the company. And it's a matter of time before we see the volumes from these products kicking.
Okay, so overly optimistic, says Avinash Gorakshakar. You might see a bit of a downside today because of that CLSA note. Is it an opportunity to buy or not? We'll come back and ask Khush Bora that. We come back with the pre-open rates as well. Very, very small break. Stay tuned. We'll be right back.
Back with India Market Open right here on NDTV Profit. Let's welcome in Chandan Taparia, Head of Technical and Derivatives Research at Motilal Oswal Financial Services. Chandan, great having you as always. Thanks for taking the time out. How are you approaching trade today, Chandan? Kush was telling us that he's hoping for seeking a holiday from index trading, at least simply because it's going to be very risky to trade the index today. Not that it is showing too much of trends any which ways. Are you trading the index or are you focusing on specific stocks?
Good morning. Thanks for having me. So I have same kind of thought, but I have different reasons as well. First, that market has got stuck in a range from last 3 days, but trading at lifetime high. We are holding well above 50, 25, 250, 25, 300 zone. But again, some follow-up is required. We are waiting for outcome from FOMC meeting or comment from the Fed chairman. And I believe the Indian market will take the cues from the same. And apart from that, I think the most of people are now emotional and blessed after the Ganpati Visarjan, especially in Maharashtra. But I believe the trend is positive, so I'll continue to be with bullish stance. However, can go with the option strategy rather than taking the naked positions, because as per the US market, our indices will open gap up or gap down. So as of now, till Nifty holds above 25 250 zone, bias could remain intact for an upside target to us 25 550 to 25 750 zone. Now looking at the stock specific, it's better one can trade for intraday point of view, and if carrying, then need to hedge the position. One can go with buy on Hero Moto, positive on the selective auto name, especially on the two-wheelers, mainly Hero Moto and Bajaj Auto. So Hero Moto has been making higher top side bottom on the weekly and the daily chart and holding well above its rising support trend line. It has given a fresh breakout, so one can buy with support of 58.20 for an upside target to us 62.50 level. One more trading idea, that is buy on NTPC. A selective power name could be in focus. NTPC has taken support at its lower band of the trading band. So with support of 408, one can look for an upside target to us 430, 434. So I will go for selective bets, but will continue to be with bullish stance in the market with buy on decline view.
Bullish stance, buy on decline, going for specific bets. The interesting piece is Hero seems to be featuring in almost all conversations, and no wonder the stock had a big move in trade yesterday. The question is, can it build on from there? The first rates, and these will change of course, but look constructive. Let's see if that were to do well. Today Bajaj Auto has not been devoid of strength either, Chandan. Today there is a brokerage note notwithstanding. Is Hero the favorite from amongst all of the two-wheeler stocks, or do you believe the others can also do well?
No, I don't want to go with most of the auto name, because I see the different set of view in the Nifty auto segment. If you look at the Nifty auto index, it has been moving in a range from last 6-7 weeks. Tata Motors has started to form lower top, lower bottom and can drip down towards 950, 940 level. Ashok Leyland has seen a built-up of short position and has been making lower top, lower bottom with hold below its 50-day EMA. So I'll go with very specific name. I don't have entire positive stance in auto, but very specific, either Hero Moto at current level or Bajaj Auto. I'll go with buy on decline stance.
All right, point well noted. Okay. Well, we'll get into the top brokerage call in a moment, but before that, Avinash Gorakhshekar, we've spoken about two-wheelers. From amongst the four-wheeler pack, and I buy the point that Chandan is making, that autos have now started to look very sluggish. Just that the one which is trying to make a bounce felt is Mahindra and Mahindra. Showrooms are brimming, bookings are looking strong. The last month numbers, the monthly bookings looked very strong relative to a Maruti or any of the other private players like Hyundai as well. Is M&M an investment candidate, or would you rather not look at autos and look at other pockets?
No, I think longer term, Niraj, I think M&M definitely deserves to be added in your portfolio. I would believe that it's got a very diversified product base, a very strong balance sheet, and I think, as you rightly mentioned, despite the fact that most of the auto companies, including M&M, have cut prices, because supplies have become more smoother now. Markets are not working in supply crunch driven kind of scenario. So, despite that fact, volume growth for M&M is going to be quite promising. I think apart from the fact that both the agri as well as the UV segment is doing well, they've also made a conscious effort to aggressively move into the electric vehicle category. So I think, you're going to see a lot of action in terms of product development, in terms of new product launches. So I would continue to be positive on M&M. I think you need to give in a slightly longer term kind of time frame, at least the next 12 to 15 months. Because the stock will consolidate initially. And as you rightly mentioned, there's been a sluggishness in the auto pack, largely because, there have been some news reports, specifically for passenger car companies, that a lot of inventories have got piled up at the dealers' ends. So this gives you clearly a slight uncomfortable feeling. But I think probably, now the festive seasons months are going to start from October onwards. And I think you could see a decent pickup in the auto volumes. So I think despite price cuts, volume growth should be in strong double digits. So my M&M is a buy. I would suggest that it is a must for your portfolio, provided you have a time frame of next 12 to 15.
By the way, I must say that the next 13 days, and therefore the month of September, will look very wobbly. One, that there are inventories piled up. Two, now we enter the Pitru Paksh or the Shraddh period until October 2nd, if I'm not wrong. A lot of people do not, or rather avoid going out and buying vehicles or any major goods and service. So therefore, if you're not a believer, it's the best time to buy into any car or something, or a vehicle, because you get fabulous deals from dealers, I must say. But I would reckon that a lot of people veer on the side of caution in the Pitru Paksh period. They do not go out and buy, and therefore autos may have a very wobbly month of September, especially because it's a twin blow. One, that there is this period which is considered inauspicious, and there is a large inventory build-up at multiple auto companies, and therefore that clearance might happen. So primary sales might be very, very difficult. So viewers, bear that in mind. Okay, what else? I think from stocks that are moving or reacting this morning, SKF seems to be reacting all right, about 2.5–3% higher. Remember, this is a global deal. It doesn't have a natural impact on the Indian business. Having said that, the stock is doing well. Kush Bora, is SKF a trading stock, or would you avoid it?
No, I would avoid it. Anyway, this is not one stock that you trade as much, more of an investment kind of a bet. The stock is very clearly showing, signs of revival. There is a good chance that, it might continue to do so. The last hurdle from technical, from a technical standpoint, at least, is the 50-day moving average, where it closed for the last 5 sessions. The gap up opening today will perhaps place it comfortably above that. So I think from a medium-term perspective also, if someone wants to enter, then this is a good time. Looks like the near-term correction is complete, and the stock could now head towards the levels of 6,000, and once that is taken out, perhaps to 6,300 as well.
Couple of pockets which are in news. So REC is raising capital in not equity capital, but bonds, and has made some commitments towards renewables and investments thereof. So REC PFC seem to be doing okay at the end of the pre-open session. The other two, duo, is Oil India and ONGC, because of the windfall tax, a bit of a bounce there. Now, oil prices being lower structurally means negative for ONGC and Oil India, by the way, but there is a bounce today. So Chandan Taparia, would you play the bounce into ONGC and Oil India? And maybe give me a view on PFC REC too.
Yeah, so Niraj, first to comment on, you said about the Pitru Paksh, and definitely that will be the key reason that why selective sector will perform, and again there is some Rasi change, and because of that some volatile swings may be there in the metal, auto and global markets. Yeah, but coming to question on your ONGC, the stock has witnessed some profit booking decline in last 3 to 4 weeks, has been making lower top, lower bottom. As of now, it seems that the early sign of bottom is forming. It has corrected from 334 to 283, and now negating its lower top, lower bottom. So I believe with support of 288 or 290, it can witness some recovery towards 310 kind of level. So I believe some recovery can be played, but one need to keep in mind that overall setup is in pressure. If I talk about REC Limited, same set of picture, but I believe upside could be kept. Multiple hurdles are there near 570. It may bounce till 570, but it would be tough to hold beyond 570. So ONGC, one can play the bounce, but I believe REC and PFC need to wait whether the bounces are being respected, or again selling pressure happens at higher levels.
Okay. Well, but could there be selling pressure in IT, or specifically on TCS is the question. And the reason I bring this question up is because of this Macquarie note that Puneet is going to highlight for us. Puneet, what does Macquarie have to say when it comes to TCS?
Well, they're maintaining their very bullish stance on TCS, and they're also comparing it with Infosys and preferring the former company. Now, they have a target price of roughly around 5,740 rupees per share, a 27% upside from the previous close, and maintaining the outperform rating. Now, they have said that, the top large cap IT companies, services, it's one of the picks going forward as well, which is TCS. They have mentioned that, they're expecting more cloud migration deals with applications in infra services as well as software being bundled together, and that's being one of the most positive things going forward. They expect TCS to be better placed than Infosys in winning bundled deals going forward, and that's something that's not played out post-COVID, because we saw a lot of singular deals, single focus deals happening. So going forward with the increase in spending, they see TCS being a bigger beneficiary than Infosys. They also expect TCS has of course grown faster than Infosys during the spending rebound phases previously over the last 2 decades, and once the spending rebounds happens again, TCS could be one of the biggest beneficiaries. They say that TCS is currently trading at about 27.6 times price to earnings for FY26, very close to where Infosys is at 27.4 times, and specifically they are targeting roughly 35 times price to earnings for Infosys, which is for TCS specifically, which is why the target price of 5,740. So building in spending rebounds going forward, and expects TCS to outperform versus Infosys in this particular note. Back to you.
Okay, Puneet, thanks for that. Avinash, any thoughts here? Macquarie believes that TCS might be better placed than Infosys, but independent of a comparison between the two, in absolute terms, is large cap IT a buy, or you would pass it?
No, I think, Niraj, I would be a little cautious even now on IT, and I think large cap IT definitely has a good value proposition as of now, provided the timeline is slightly longer. I don't think any big fireworks in the short term, but I think as Puneet was mentioning that a lot of bundled deals could come into TCS very shortly. I think the bigger opportunity could be after the presidential elections. A lot of uncertainty could get cleared, and I think after that possibly a lot of deal signing up, a lot of unrealized kind of project work could get transferred to large companies like TCS, Infosys, HCL Tech. So we are probably waiting for this event to unfold. I think the Fed decision is one point, but I think a bigger opportunity for IT companies is once the presidential elections are over, and then I think you could see a little more stronger visibility from the US market, which is one of the largest market for Indian IT companies. So we are long-term positive, but yes, in the short term, I would not be surprised that this note or maybe the view which is being put out here is going to result in a kind of a runaway rally for the stock. So it's better to put on hold. I would prefer to wait for some time and then take a call, for the longer term.
Got it. Okay. So wait for the wait, if you will, in the short term. In fact, well, you would argue in the short term, a lot of things might start looking very good if the Fed gives only 25 basis points. I must bring out, though, the Morgan Stanley view. I used it in my trade setup on digital, and therein Morgan Stanley is giving out this view, and we should pull up those graphics here, that they believe that India, and they are constructive on India relative to China. They are overweight India, underweight China, and they say that they believe that India's ranking on the MSCI weighted list will keep on rising. It's second in the list of the rankings currently, and it can actually go up higher as well. So that's to be kept in mind. Morgan Stanley says that India will continue to gain due to market outperformance, new insurances and liquidity, and India has displaced China as the largest MSCI EM market. By the way, this is on a IMI basis, which is investable, large, mid, small. It's not on an absolute basis, so this line needs a bit of a correction, but be that as it may, they are very constructive on India relative to China, so that's to be kept in mind. Okay, time for the top strategies. We've already gotten the strategies thus far, but I'd still love to ask Kush Bora, if you had to bet on one stock for the day today, which one would that be and why?
It's a fairly recent listing, but the moves have been very encouraging. So that is Emcure Pharma. If you see the last couple of sessions, there has been a good volume uptake, and the stocks actually rebounded quite smartly from the post-listing profit booking that had come about. So, as I said, the momentum is, going for this one. If you need to enter and hold, then also this is one of the, looks like one of the good candidates, because there's been a steady uptick ever since it hit that 1200 kind of low levels. So on the upside, you're looking at about 1600. Once that is taken out, 1660 also as your target, and a good stop loss for this one comes in at about 1450. So Emcure Pharma is popping up on some of our lists.
Okay, by the way, Kotak has an ad on Emcure Pharmaceuticals today, so do watch out. They are constructive, Kotak Securities as a house. Chandan Taparia, your one top call. You've given us 2 or 3 already, but if you had to narrow it down to one.
Yeah, I'll only go with Hero Moto with the view that this stock may be hero for the day by giving 2 to 3% run up, being the heavyweights. So with support of 58.20, I'll look for target towards 62.50.
It could be the hero of the day according to Chandan Taparia. Okay, we'll watch out for this. Stay on, gentlemen. We'll take in opening thoughts from you before we thank you. It'll be interesting to see what happens to Hero MotoCorp. Interesting to see what happens to Bajaj Housing Finance because it's starting off flattish today. Remember, viewers, after having a really good run, it's starting off on a flat note today. Some point of time, gravity would come in. So that's the other interesting one to focus on. And we'll watch out for some of the wind equipment manufacturers because Inox has gotten that order. We'll watch out for REC because it's committed to some serious renewable targets and renewable lending as well by 2030. But here come the first rates, flat. I really doubt that IT is doing something dramatically different. Banks certainly are flattish and mid-caps and IT has stand corrected down about 1%. Interesting. Okay, mid-caps and small caps marginally in the green. But I'm intrigued to see what's happening in IT. So let's take it to the heat map and show you what's reacting. LTI Mindtree down 1.5. Infosys, TCS, Wipro, HCL, Tech Mahindra. IT is taking it on the chin today. Some sharp knockbacks into the IT stocks in trade. But not that NASDAQ was really untoward, but pretty interesting. Something that I may have missed. Excuse me for that, viewers. Bharti Airtel correcting a little bit. JSW Steel marginally off. But can't take my eyes off IT really. What's doing well though? Shriram Finance poking up another 1.5%. Britannia, Bajaj Finance, NTPC, ITC. Don't quite see, Hero MotoCorp, another 0.5%. So that is in the reckoning as well. HUL, another 0.5%. ITC, so FMCG seems to be bouncing back. But the hero sector, for the wrong reasons, is IT really. It's really sulking in trade, excuse me. And it's negating the benefits of FMCG, by the way. Okay, let's get Bajaj Housing Finance on the screen once. And then let's get the movers and shakers on the Nifty 500. The top gainers and losers there. Bajaj Housing Finance down 5%. So a bit of a gravity for this one. Maybe Gadgil could also come in before we get BSE 500, or we can go to BSE 500 straight, either of the two. But Bajaj Housing Finance certainly seeing some gravity. Should pull up PN Gadgil. Or let's go to the BSE 500 list very quickly and show you what's moving and what's not. Torrent Power, order win up about 4%. Alkyl Amines 3%. Quest Corp about 2.5%. REC about 2.5%. Radico Khaitan 2.5%, Nykaa 2.5%. But you can see that the top gainers don't have really meaningful gains there. On the losing side, Emphasis, LTI Mindtree, Wipro, Oracle. It's clearly Nifty IT which is taking it on the chin. There is Blue Dart as well, and VST on Radhakishan, the money selling stake, down about 3% as well. So these are a few other names. Can we get PN Gadgil and just see what that stock is doing? Because after Bajaj Housing Finance correcting, PN Gadgil flattish in trade. The new listings cross also could be actually in the red. So because it was down 5% yesterday, if I'm not wrong. Well, currently flattish in the session. So Tamanna, that's the list from a lot of these, and I'm inclined to ask our guests about IT. But what else are you spotting?
Yeah, absolutely. You have a morning which is fairly quiet, Niraj, and as expected. I mean, before we started the show, Kush Bora was asking for a holiday, and this is perhaps why, because not too much action. I mean, look at your top gainers also not moving to that extent. I just want to see what a Bajaj Auto is also doing, and I'm sure you pulled it up, but let's look at how a Bajaj Auto is faring after that CLSA note, and whether there is a big downside there. Not really. That very negative view is not being taken that seriously perhaps. Torrent Power, the big winner of the morning, as was to be expected because of that deal or that big allotment from the Maharashtra government. Some of the rail stocks, let's look at if any action over there. Let's pull up a Jupiter Wagons, let's pull up a Titagarh and see if there's any action in any of these counters. Jupiter is not doing too badly in relative terms, about 1.5% up, but not so much for some of the other counters this morning. So all in all, I would say a relatively quiet start. BSE though, BSE is the other counter that we should talk about very quickly. Buzzing once more on hopes, once one presumes, of NSE listing and then that whole space getting lifted. I'm seeing some interest in Paytm as well, 2% up. RVNL among the other rail stocks that is working on the new details which have come in on rail. CapEx, CG Power and SJVN is the other ones that are catching my eye this morning. And of course, Nykaa, as you spoke about. But really, it is tech which is hurting, and mid-cap tech as well. Emphasis, Oracle Fin, look at Persistent Systems, L&T Tech, Coforge, all of them, seeing quite a bit of loss this morning. Emphasis specifically. Let me go across to Kush, Avinash, Chandan, all of them with us this morning, and tracking the markets as we speak. Chandan, let me just ask you about what you have spotted and any top calls after the way the market is opened, or would you just play it safe?
No, safe is always important. But again, I believe there is a trade in every time in the market. You need to just explore. I've spoken about Hero Motocorp, and I believe that is going to be the hero trade in FNO. And I think that is up by more than 1.5%. If you want 2-3 more names, I'll focus on the capital market. I believe that MCX could see the fresh breakout. Counter like Bombay Stock Exchange, BSE can deliver the further movement of 5 to 10%. And I have Radico Khaitan on my radar, which can deliver the rally of 8 to 10%. So apart from Hero Moto, 3 stocks which have high probability to rally by 8 to 10% are MCX, BSE and Radico Khaitan for the day.
Chandan, IT, why this thing? I mean, and is there a trade therefore that comes up?
So major trend of the IT is positive, but I think most of these stocks are waiting for some trigger from the Nasdaq led by comment from US Fed. So overall positive, but I don't think we should attempt for today. Let them get some stability. Major trend is positive, but on decline, I'll focus on counter like Coforge. So if I have to give the levels in advance, then Coforge is now holding near 69.30. Let it come near 67.50 to 6800 to go for again buying interest for rally to our 7200 marks.
Okay, so Coforge would be one call on the Nifty IT. I mean, you could see a turnaround in mood as early as tomorrow itself. Remember, 11:30 onwards is when you will hear from Jerome Powell and live on NDTV Profit, by the way, in case you're wondering, all our social media platforms as well. And that's when you could see impact on NASDAQ and then the Nifty IT. But thank you so much, Chandan, for joining us this morning. We're still with Kush and Avinash. Kush, just, your index calls after the way Nifty, Bank Nifty have opened. And let me add Nifty IT. Is there a trade there?
So, Tamanna, view remains largely the same. I mean, we've not seen, a big move or any kind of, a direction, even if it's been just 6 minutes, since the markets have opened. Not really seen too much. I think the positive bias on Bank Nifty continues. So I would avoid, the Nifty and the Bank Nifty for trade per se. But as I said, I continue to maintain that, the bias on the Bank Nifty remains positive. Now, as far as IT goes, yes, something that even Chandan mentioned. Perhaps these stocks are waiting for a trigger. But I think the fortunes of the IT stocks and metal stocks in some way seem very similar, just that metals are linked to China, where the data is not really as transparent and not as encouraging, whereas US, a lot of dependency there. The data, there's a lot of visibility, but the data seems to be mixed every now and then, and these stocks react to that. Largely, the trend is positive. Any kind of pullback on a stock like an HCL Tech should be considered as a buying opportunity. Now, just a quick update on a stock that we discussed yesterday, which was Shriram Finance. And the reason for update is that this was a BTSC call. 34.25 was the initiation price, 3,500 target. The stock's up more than 1.5%. Not a bad gain for an overnight trade. So if you've got a position, you might want to either book it or hold this with a trailing stop loss of 34.50. So Shriram Finance, you might want to now place your trailing stop loss close to 34.50 and ride it for a move up until 3,500 or higher.
Okay, so Shriram Finance on the radar. Avinash, your first take, the one segment that I'm seeing doing fairly well today, and maybe that's on the capex boost after the 100 days buzz, is your Nifty PSE. So look at a PFC, RFC, REC, those counters are doing well, and NTPC, Coal India, relatively doing okay on this morning, but PFC, REC actually on top of that list. So would you look at any of these spaces on the capex expectations? What are the stocks that you would stick to this morning?
I think within the PSU basket, we are positive on power generators like NTPC, typically even a Torrent Power. Our sense is that some news flow has come in today that Tata Power plans to invest about 75,000 crores for its green initiative. So I think definitely these companies should be in the limelight. But as far as cement is concerned, we continue to be positive on smaller cement players like Heidelberg Cement. My sense is that the second half now is going to be the busy season for most of the cement companies. So I think even at the current odd levels, if one were to take the next 12 to 15 months, we are looking at a fair value of about 290 to 300. So I think select pockets should do well. I think today's market is of course very volatile and wobbly. But if one were to look at delivery trades, I think definitely something like a Torrent Power, typically a Torrent Power, as well as something like a Heidelberg Cement. I think one should accumulate over the longer term. I think clearly one could see good amount of value coming in here.
Ola Electric is another stock that's buzzing this morning, another 4% up, and BSE, I think, winner this morning, definitely 7% up over there. Chandan spoke about BSE on the charts. Kush, are you liking BSE?
Oh yes, I think we've had this discussion, I think 2-3 days ago as well, when the stock was up, about 8-10% in a session. And from there on also, my view is very constructive on this one. I think you should have this in your portfolio. Momentum has also come about after a hiatus of 4 months. The stock was trading with a negative bias. I think the trend has changed for this one. I wouldn't be surprised if this stock moved to 3,700 or 3,900 levels in the near term. So BSE from a trading perspective also looks good, and if you want to add it to your portfolio and hold, that's also not a bad idea.
Avinash, wanted your view on an Ola Electric, which is again doing well today, day after that Goldman Sachs note. And I don't know if you are positive on BSE because of an NSE IPO. Fundamentally, is that making sense to you?
No, I think BSE definitely should benefit, Tamanna. I think clearly, NSE is an issue which was longly awaited. And I think now with all the regulatory hurdles going out, I think BSE on its own has been doing pretty well. The derivative turnover has gone up. I think clearly in terms of the competitive positioning, apart from NSE and BSE, there's hardly any competition. So just like CDSL, which is like a quasi-monopoly business, I think BSE stands out, if at all the market does well, more investors enter the market. So BSE should be a good compounder over the longer term. As far as Ola Electric is concerned, I think, this is a futuristic stock. Somebody who has a 2 to 3 year kind of timeline can definitely consider this as a contra call, because currently the electric vehicle business is just at the starting tipping point of growth in India. Over the next, say, 3 to 5 years, if everything goes well, if Ola Electric delivers as per what their target plans are, then I think there's a huge runway to be done by the company. As of now, I think there are no data points to justify this stock on fundamentals. But yes, from a long-term perspective of the next 2 to 3 years, if they start generating good amount of profitability, then I think definitely the potential is there. They have one of the largest base in the country, and I think obviously they should do well. But yes, this is going to be a longer-term story. In the short term, the stock will continue to remain volatile.
Okay, so some details may be coming in on why IT is suffering today. It's a Bloomberg report that is saying Accenture could delay bulk of promotions by 6 months on Outlook. Technology consultant to announce staff elevations in June. The industry has been cutting jobs to weather a demand slump. So the weather vane of sorts for the IT sector, the big global player Accenture is delaying its promotions because of the way that they see the outlook in the industry by 6 months. That's a bit of a warning sign for Indian IT companies, and maybe that's part of the reason that you're seeing a bit of a knock today. All right. That's all the time we have with you, Kush and Avinash. Thank you so much for joining us today on the show. And, we're wrapping up at least this section of India Market Open, Niraj, with a bit of, I would say, caution. We'll have to see what the rest of the day looks like. But I wouldn't be surprised if you see a round of weakness coming in before we close today, with the signs that we're seeing at least this morning. Bajaj Housing Finance is back in the green. So after some sellers came in, the buyers have swept in again, but not massively.
Tamanna, the other interesting thing is, though, that despite the fact that the Nifty in IT is down 1.9% now, the Nifty is still holding up and just absolutely flat. So maybe, just maybe, some strength in the others. which is helping the markets hold up. Just before we get to the next conversation, if we can just put in the points contribution of the different stocks on the Nifty today, because I'm certain that the IT names will be on one end, Infi, TCS, HCL Tech, Tech Mahindra, being thwarted by some performance by HDFC Bank, Bajaj Fin, Reliance, ITC. It's like the rest of the market is kind of negating the negative points of IT. So pretty interesting, really. But what a knock for IT, Nifty IT today. Quite stunning, really.
IT and financials doing their seesaw as they, usually do. So in this case, financials on the upside, and Bajaj Finance maybe thanks for that Morgan Stanley note as well, in part seeing an upside.
Yep. Okay. But on to big voices and ahead of the Fed. It's a very important voice that we're joined by with Gargi Pal Chaudhary, Managing Director and Chief Investment and Portfolio Strategist Americas at BlackRock, with us on the show today to talk about her thoughts of what happens next. So Gargi, good having you. Thanks for joining in. What do you expect the Fed to say and do this time around, and the subsequent impact on risk assets?
Just over the last 4 days or so, the probability of getting something larger than a 25 basis point cut has moved higher. I think there are a couple of reasons that investors and anyone that's watching the show should focus on as it pertains to the Fed. Obviously, this is going to be the first of what we think is many rate cuts. So this is the beginning of a rate cutting cycle. Of course, whether it's 24 or 50 will matter that on the day off and for the first couple of hours after the FOMC meeting and the press conference. But I think in the larger scheme of things, what's really going to be important for both bonds and stock investors is around the depth of this cutting cycle and the speed of which. And most importantly, I think the third thing that investors should focus on is why the Fed is cutting rates. Are they cutting rates because inflation is coming down in a meaningful manner, or are they cutting rates to stave off a recession? And I think those are the things that are going to drive the markets in, after the first 24 to 48 hours.
Okay. What do you think, Gargi, is the impact of the Fed move based on history? Because we've seen history, looked at 2019, maybe 1995, and looks okay. 2001, 2007 don't look okay. So how do you think the markets or risk assets do based on what the markets have done traditionally in the past?
Absolutely. And, my team and I have spent a lot of time sort of analyzing the data around previous rate cutting cycles. And we've gone back to periods. And some of those periods have obviously followed with a recession. So the Fed has begun to cut rates because of the fear of a recession, or in the case of obviously 2020, which is the most recent cycle, in the midst of a recession. There were other periods, obviously 1995 comes to mind, as well as 2019, as you correctly point out, which were not in the midst of a recession. So I think how the data and how the returns are going to pan out is going to be important. As of today, and as of the time that the Fed, goes into their very important decision-making process, the data is certainly moderating. The data is certainly weakening, especially, we've seen the labor market in the US softening a little bit from about 6 months ago, but none of the data yet is actually in recessionary territory. And I think that difference is really meaningful. So the level versus the change. So the level is actually, it's softer than it has been in especially the first part of this year and last part of 2023. But if we look at the change that's gone through, obviously the data is weakening. So I think as of right now, we're not really, whether we look at the manufacturing sector, whether we look at the consumer, whether we look at the labor market, none of that is pointing to a recession. Of course, that can change. And a lot of that will depend on how the Fed handles this cutting cycle. With a recession in our forecast, I think the data shows that 12 months into the cutting cycle, equity market returns tend to be very positive. We're telling investors certainly to stay up in quality in this period of slowing growth. We're certainly telling investors to take a very strong advantage of the incredible income that's available in the fixed income market. So there are a lot of opportunities. And as of now, we're trying to tell investors how to position their portfolio in the case that we don't have that deep recession.
To be my next question to Gargi, but just before, Gargi, just stay on because I just want to tell our viewers, the market seems to be positioned for a 50 basis points. What if we get only 25 basis points because of precisely the reason that Gargi mentioned, that the economy is not in as bad a shape as people think? Because remember, yesterday official figures showed that the US retail sales in August were actually stronger than anticipated. And as per a Goldman note, US financial conditions are the loosest since April 2022. So in some sense, some people would argue that we don't need a 50 basis points. It's okay if it's only 25, but just that the market is currently working with 50. Now, Gargi, be that as it may, my question to you is, what is the best way, or where is $100 best split in this easing cycle? Developed markets, equities, bonds, emerging market equities, bonds, how would you split?
Yeah, I think a lot of that will depend on what your investors' sort of horizon is and what their goals and investment objectives are, right? So there'll be a lot of investors that are certainly closer to their retirement age, and they'll spend a lot of that hypothetical dollar. A lot of that will go towards income-generating assets because they don't want to have too much of their portfolio in that growth and that equity part of their portfolio, and especially globally, but certainly in the US, fixed income markets are garnering such a tremendous amount of income that I think that makes a lot of sense. If you're younger in your career, certainly those that are investing for the first time or investing and you have many, many more years of working left, some of that dollar, a lot of that dollar certainly should be going towards growth equity and certainly going towards areas of the world where we think growth is going to come from in the years to come. And emerging markets, certainly fit that bill very well. When we look at certain parts of the emerging market, and obviously India and Mexico are examples of this, where we're going to see a couple of things. We're going to see demographics remain very positive. We're going to see central banks remaining very much, in accommodative territory. I think in those markets, I think playing for some of that in the long term makes a lot of sense. But, it's very difficult for me to sit here without looking at an investor's portfolio or understanding their risk objectives to say that this is exactly how it should be played out. I think it very much depends on your investment objectives and your years till retirement. What I will say is no matter who you are or where you are in your investment journey, I think recognizing that fixed income markets today, especially I will say in the US, are very different from what they were sort of 10, 15 years ago when many of us started our careers. And I think that really makes things very different in this market. You can earn that income in fixed income, which for a long, long time after the financial crisis of 2008, you could not.
Okay. Point well noted. Okay, let's talk about what Indian investors can do when it comes to fixed income markets in the US too. I mean, Gargi, we look at TLT very, very actively too, and that's the instrument to invest into, one of the instruments to invest into US fixed income markets. So my question to you is, are you inclined to invest into the US fixed income markets? Is there more juice left there?
I love that you're looking at TLT. That's our bread and butter. So I love that we're talking about TLT in India. I do think that TLT, for those who are not as aware, is really looking at the very long end of the treasury market in the US. And certainly for those investors that are looking to increase the interest rate sensitivity of their portfolio, holding something like that makes a lot of sense if you want to increase the duration of your portfolio very quickly. What I will say is, as we're thinking about the entirety of the interest rate spectrum of the entire yield curve, where we're finding the most amount of interest right now, or most amount of valuation right now, is really in the belly of the curve. So we call that the 3 to 7 year part of the curve. And the reason we think that the 3 to 7 year part, so something like a BINC, which is an active ETF, or even an IEI, which is an index ETF, some of those make a little bit more sense, we think, because the longer end, so something like a TLT, can be impacted by the rising issuance that's going to come in the United States because of the rising deficits here. And the very front end, which is sort of the 1 or 2 year part of the yield curve, is already pricing in a tremendous amount of rate cuts. So we're currently looking at over 225 basis points of rate cuts between now and 2026. It's going to be very difficult for us to realize all of that. So we think that the belly of the curve, so the 3 to 7 year, is the most attractive right now. And that's where the valuations we think are befitting for investors for the time being. But certainly, depending on your horizon, depending on what you're looking for in your portfolio, many investors are grabbing for yield right now. They want to lock in, and TLT has been an excellent use case for those investors, and that makes complete sense as well. So I think the use case matters a lot.
Got it. Okay. Now, Gargi, when I was thinking about what could happen, and somehow I thought that maybe rates could go back all the way to this 2019 lows, and therefore this whole higher for longer trade will reverse fully. Do you agree with me, or do you think about it differently?
Of course. So, absolutely. So if we look back to where 2019 and where we were when the Fed started cutting in 2019, we were already in the high twos if we think back to. So when they started cutting in 2020, of course, they brought rates back to zero, but at that point, Fed funds futures were in the mid twos to high threes, so 2.75 or so. Actually, if we look at where Fed funds are today, before the Fed has cut rates, obviously, we're at 5.375. But what the market is pricing in by 2026 is right at that 2.75%. So the market has already sort of priced in a lot of that rate cut. So if you look at the futures market, it's predicting that rates in about a little less than 2 years' time is going to get back to that 2.75% level. Now, our view here is that inflation, in the pre-pandemic era, so if we look back at CPI or PCE inflation from 2000s to 2020, it was always a little bit below the Fed's target. So it was somewhere around 1.8% on CPI. We don't think that we're going to get back to that era. So for us to imagine that rates are going to go all the way anywhere near 0 or even 2% is very unlikely. So I think how the Fed signals, especially at the September meeting, around where the level of neutral rates is, and of course that neutral is that level that neither slows nor accelerates the economy, that level of neutral rate is not, we don't think, is back to being 2% or even lower than that. I think we've got enough evidence that that's somewhere around 2.5%, not even higher. So hard to imagine that we're going to get back all the way, below 2, but the market has gone a long way to pricing in, Fed funds going back to 2.75. That's where it's sitting right now. So when you talk about 2019, some of the pricing is already there. However, in the belly of the curve, which is again that 3 to 7 year part, which is the one we prefer, you haven't quite seen the move. So the 5-year treasury certainly has a little bit more to go. And that's where we think investors should be thinking about locking in yields, not just in treasuries, but also in high yield and securitized assets, as well as in certain parts of investment grade credit and emerging markets.
Okay. My last question, Gargi. Is this going to be a swift easing cycle? And therefore, if that is the case, what is the attractiveness of emerging markets in this cycle, let's say till the end of the year or otherwise?
Yeah, so the two different lines of thought here. On the fixed income side, certainly the belly of the curve. On the equity side, we're telling investors to go with higher quality equities. We're telling investors to sort of continue to think about companies that are returning very stable, looking at very stable earnings growth, as well as low leverage. So it's, two different parts of your portfolio. Certainly focus on those large cap companies in the equity markets. As far as emerging markets are concerned, I think that in the near term, so by that I mean maybe between now and the end of the year, there are a couple of things that could serve as a little bit of a headwind. Obviously, U.S. election being on top of mind. I think once that's passed through, I think emerging market equities as well as emerging market debt could once again be a very strong part of any investor's portfolio, as it always should be. But I think your investors should be a little bit cognizant that right now going into the U.S. elections could be a period of a little bit of volatility for emerging markets, and certainly for that matter for U.S. equity markets as well, which is also why we're telling investors to be up in quality, focus on earnings growth, be in those companies that are likely to have the most amount of cash flow, and we think that that's going to preserve you a little bit better in a volatile period.
Gargipal Chaudhary, such a pleasure talking to you today ahead of such a big day. So thanks for taking the time out and being with us. That's the view from BlackRock. It's as informed as they come, and really important to get this view all the way from New York. Well, that's one. And now let's stick with this and hear a view coming in from Cholamandalam Investments, Arun Selvan, sharing his outlook on auto loans and more.
Yes, there is an expectation that there will be rate cuts. My personal view is it will take another quarter or so before RBI will follow suit of the FOMC action of reduction in rates. Having said that, yes, it will have positive impact to us because while we are dependent mostly on bank lending, most of our bank lendings are benchmarked with indices rather than under MCLR, which makes it more amenable for absorbing the rate cuts that could come up in the near future. So we will benefit a bit on the rate cut. However, the extent of rate cut is to be decided only once we know how much RBI is willing to forego on that side.
Obviously. But just for starters, say we're talking about, and you're right, we might take another quarter for the rate cut cycle to sort of churn in India. But if we start with, say, a 25 basis point rate cut, as an exercise, what does a 25 basis point interest rate cut mean for you on the margin front?
I would say in a very ballpark, almost 50% of that could pass through because, the rate cut would be effective only mostly on the marginal borrowings, while some of the previous existing borrowings will undergo change as and when they come up for reset. There could be time lags on that. So I think in an immediate effect, you can see on a 25 basis points, around 10 basis points coming on to the NIMs, and progressively the balance could come in as the rest of the book gets reset on those respective reset dates.
So a 25 basis point rate cut means a 10 basis point impact on NIMs, and this could come in by next quarter is the expectation. Obviously, we don't know when and how much and what the RBI does. But having said that, Mr. Selvan, just to understand, has the interest rate regime so far been any kind of a deterrent to demand that you've been seeing? And I'm wondering if you'll see the reverse happening in terms of demand growing if rates actually are cut and some of that passes through.
It has an impact, yes. You would have seen that, from the COVID days versus when the rates were really low to now, the rates have moved up and we have absorbed the rates. And wherever we could do a rate reset where the book is on a floating rate basis, we have done a change in rates immediately on the most part of the book, which are amenable for change. Whereas the vehicle finance book, which is more a fixed rate book, is not amenable to change on the existing book. So there we need to only move towards changing the marginal rate of lending, which takes a longer time to reflect in the overall book. However, you are seeing this progressively coming into play, as you may see that in the vehicle finance book, NIMs improving over the quarters, and you will see some more benefit coming in by the yield change also in the subsequent quarters.
How much of your book is fixed right now, Mr. Selvan?
On the lending side, which is our lending to the others, it is around 60% of the book is fixed, and the balance is floating.
Okay. Just, because auto loans is the big business driver for you. I just want to get your sense about how you have seen appetite, considering the numbers that we see from the industry on the CV front, even passenger vehicles have not been as robust. Two-wheelers might be a bit of a different story. Are you seeing that reflective as well?
Yes, we have seen some tightness, more in the case of a heavy commercial vehicle. Thankfully, we focus on light commercials and mini lights on the commercial vehicle front. Even on the passenger car, the focus is more on rural. We need to see how the demand pans out. While monsoons have been fairly robust, the continuing monsoons into September is actually a little bit of a negative, because there we will see if there are over supply of water also is a problem in rural. So we have to be careful about that. We are waiting and watching. Most of the festivals are happening in Q3. That's when we expect the demand to zoom up, and we see including passenger cars and two-wheelers and tractors demand going up in Q3. We need to wait and watch in Q3. Q2 would be similar to Q1, yeah.
Okay. I was just going to come to that, in fact. What's the outlook for Q2? Because in Q1, you saw net interest margins at about 7.6%, slightly on the softer side. PAT was looking good, though, at 30%. So you see those sort of overall numbers continue, at least on the NIM side?
I can't talk too much about Q2 being, it's at the quarter is to get over. But I see similar trends, panning out in Q2 across various line items.
Okay. And you're saying festive, of course, a bulk of it in Q3, so we'll see that coming in then. What is the sort of outlook for the year, taking into consideration Q3 as well? What is the kind of bump up you see on NIMs in Q3? Because you'll have a double delight in that sense. You might have an interest rate cut coming in and demand growing as well.
We shouldn't count our chickens before, the RBI announces that.
Before the RBI hatches them.
Yeah. So let's be, we, as you know, or if you have observed, we try to promise less and deliver better. So I wouldn't want to put everything on the table right now about what may happen, which would, sort of inflate the expectations.
Okay.
So let's keep it at the similar levels. Let the announcements come, then we will certainly come back to you.
Okay. Fair enough, Mr. Selvan. Under promise and over deliver seems to be a wise strategy. But just to get a sense of outlook in terms of business strategy, a bit less concentration on auto loans. Is that the plan? More diversification on the small and personal loans, the business loans, as well as the home loan front?
It is not less concentration on auto loans. Auto loans being a larger base, it will tend to grow. It is like it's more than 60% of the book, or nearly 60% of the book. So that growth will be seemingly lower than the rest of the portfolio. The focus would be more on mortgage loans, which is loan against property, and home loans. These are our, the thrust is on growing this book by both geographical expansion and customer base expansion. So we will be growing these books. The personal loan would remain more or less at similar percentage of AUM as we grow. We articulated that in our investor call. So when you look at it at an overall AUM, the share of AUM of vehicle finance will progressively come down over the next few years to around 50% levels. The mortgage book, both the LAP and home loans, would grow to around 30-35%. And then the rest of the book, which are the new portfolios, SME, CSEL and SBPL, these would be the residual 15% levels. This is what is our broad, way we are looking at growing the individual business lines.
What is the rationale behind this? If you can, tell us about what your thinking is behind the strategy.
Yeah, it follows something similar to the BCG index, right? Like you have the vehicle finance, which is our cash cow, and which will be the one which will deliver the cash for growing the new businesses. The mortgage businesses are like our stars, like they are the ones where we are now comfortable growing them. We have been using or experiencing these products over the last 10 years. And we are comfortable now in expanding the market geographically and customer wise, as I said earlier, into the entire country. We had been more focused on the south and some parts of the other regions initially. So we will now go full hog. We have been doing that over the last 2 years. We have now been growing the branch presence to almost 50% of our vehicle finance branches are covered by these products. The new businesses are the ones which are like, I would put it in the BCG terminology as a question marks, where we are experimenting them. We need to experiment and understand how and what they would pan out to be. And if we find them good to go, they will become stars of the future. And they will be the one which will, and by that time, the mortgage businesses will become also add to the cash cow portfolio.
Yeah. So your investment advisory and brokerage businesses are stars of the future category. What is the kind of upside you're seeing in them? Because high growth, but high competition as well.
Yeah, it is a separate subsidiary. We have a Stoneman Securities focusing on broking and investment. Yes, we are growing that business, and it would also become. It is right now part of the star question marks, but it will certainly become a star, given how the market pans out.
All right, that's a detailed view on Chola as well. But before we wrap up, cannot not talk about what's happening to IT. And I think banks are kind of thwarting that negative impact. But look at Nifty IT. It's down 2.5%. And this seems to be a problem for the sector, that every single point of time when people start thinking of something that may have changed for the positive, there comes a piece of negative news or commentary from the companies. In this case, Accenture, which is now, of course, saying that there is an issue. Cities put out on Accenture that surveys point to relative demand stability. Clients are optimistic towards budget, etc. But Accenture is saying, in the session today, Accenture is saying that there are issues. There are issues that push back the bulk of its staff promotions by 6 months, which is probably a sign of the slump that is hurting the wider consultancy industry. I think apparently Accenture has told employees in an internal blog post last week about the same. No wonder IT is sulking in trade. With that, it's a wrap on this leg of India Markets Open. Up next is Talking Point, and just the best time to get in. Vikas Khemani, founder at Carnelian Asset Management, who will discuss more on the much anticipated FOMC meet today and what's next for the markets going ahead. Hello and welcome to Talking Point. I'm your host Niraj Shah. It's the day of the big Fed decision. All Fed meetings are watched out for. All Jackson Hole symposiums are watched out for. This is different because this may be the start of a change in stance. I'm using the term may because it's never done until it's done. The street is working maybe with the 50 basis points as well of rate cut. But before we get in our guess, I just want to lay out what the current status of the Fed move is and the expectations thereof, and what's the resultant impact on India or other emerging markets as a result of this. So let me try and pull up some words on this wall to try and tell you what's to be watched out for. So the Fed meet has begun and the decision will be out today. The market is currently pricing in a 62% possibility of a 50 basis points rate cut. This has moved up, by the way, from about 25 basis points of a rate cut belief, which was there about a month ago. So therefore, there is a change in the market expectation of what the Fed will do. Now, the point is, viewers, what if we do not get a 25 basis points cut? So the reason why I say this is because official figures showed yesterday, by the way, that the US retail sales in August were stronger than expected, and the financial situation and the financial conditions in the US are the loosest since April 2022 as per Goldman Sachs. So there is a possibility that we might not get a 50 basis points as well. Peter Maguire today was saying that there are outside talks of even 75, but I'm saying that even 50 is not a done deal as yet. So that's the first key thing to watch out for. And that may thwart the party for risk assets a little bit. But the point is the real policy rate Z score. And I'll first lay out the numbers, then I'll tell you the importance of this. Whether we get 25 or 50 basis points, this is important. Now, India on the real policy rate Z score is at 2.1, Indonesia 1.8, Philippines and South Korea 1.5, Thailand about 0.8. Why are these numbers important? The graphics will come up on your screen next. They are important because the Z score refers to the standard deviation of the current real rate relative to the 5-year average. Simply put, if this is confusing you, simply put, a higher Z score means higher real rates, and therefore India at 2.1 has higher real rates relative to the rest of the pack for Indian reasons, but for reasons which are very specific to India, but there is a higher Z score, and therefore the possibility of the rates coming down in India, if the Fed were to be the trigger point for that, or if lower inflation were to be the trigger point for that, or both. So therefore the possibility of rates coming off in India are probably that much higher, and if that were to happen, it makes fixed income a very important asset class to look at. In fact, Amundi, in an interview to Bloomberg, has laid out that real rates across Southeast Asian economies are also higher than a year ago, which suggests room to ease, a situation likely to benefit the local bond market. Now remember, viewers, what does this do? If indeed this is going to benefit the local bond market, plus our bonds are now a part of the JP Morgan Global Bond Index and a few other indices as the case may be in times to come, it could be very constructive for the Indian bond markets as well. So do the market look away from equities completely and look at bonds, or do the markets look at both? Or is there a case that because of the perceived higher valuations, don't look at equities and look at bonds? Well, our guest today will tell me, Niraj, you are not talking sense, because he's been a proponent of equities at a point of time when everybody was talking about equities being expensive right around the election period as well. Since then, the markets have rallied another 2,000, 3,000 points. Vikas Khemani, founder of Carnelian Asset Management and Advisors, with us on the show today. Vikas, so good having you. Thanks for taking the time out. I hope all is well.
Absolutely, Niraj. It's always good to speak with you. Thank you very much for having me.
No, the pleasure is entirely ours, Vikas. I must tell you that, because it's such an important day ahead of the Fed meet. Now, Vikas, tell me first plainly, would a Fed decision or 25 or 50 basis points, what do you expect, by the way, there? And would that decision be material for global equities and for Indian equities?
I think, Niraj, this boat has sailed, according to me. It does not matter it is 25 or 50 basis point, according to me. The fact that the direction has changed, and I think that has been more important. Now, that 25 to 50 basis point can be important for a trader or a short-term player, but somebody who's investing from a long-term, medium to long-term perspective, the direction is more important. And as you remember in our previous conversation also about 6-8 months ago, we said that Fed rate has peaked out, and what time it turns or it changes is a matter of 6 to 12 months. Nobody can predict that. And I think now that one thing is very clear, that the boat has sailed, the tide has turned. Now, whether it starts with 25 or 50, that's not important. But from an Indian market perspective, why it is more important is whenever Fed raises interest rates, most US investors pull out money from the emerging markets, because the typical rule book is, as Fed raises interest rates, emerging market import inflation, interest rates increases and the equities weaken. And hence, and as the Fed peaks out and starts reducing, emerging market receives flow. And that is what precisely happened in India. We lost a lot of, we saw a lot of outflow from foreigners. And now we're beginning to see, as the indication of turn has happened, we are already beginning to see good flows. So according to me, significance of this from Indian context is that we will see a significant fund flow cycle beginning over next many years from foreign investors towards Indian markets and emerging markets.
Okay. So Vikas, the belief or the whole thing has been that flows, I mean, in the last 2-3 weeks, flows have started to some of the cheaper Asian markets already, Indonesia and the likes, right? We are starting to see some flows in the last 3 or 4 days towards India as well. Would you see the color of the money being passive, or would active foreign money also come in? Because everybody talks about one thing, oh, valuations are expensive. I know you don't, but a lot of people do. I know you're a believer. You're saying, you've told me in the past that, valuations may be expensive, but there is growth. I'm trying to ask you, what color of foreign money will come in?
Precisely, I will say that. Like I said, I will probably correct you. The point you meant, money is moving towards cheaper markets. So money is moving towards the emerging market, or money is moving away from emerging market. Now, within that, there is an overweight, underweight allocation happens. Like, for example, when last 3 years, when emerging markets were losing money, India also lost money, but India on a relative basis lost lesser money because India was looking more promising. Same way, when money is coming back, initially money might go more towards the markets where they were underweight, right? Which could be, in your definition, the cheaper markets. But my point is that this money is allocation money. And then within that, like, let's say if you give me, any investor give me money to invest into equities, I might do that allocation in different sectors. Same way, money allocated towards emerging market will do different in different markets based on their own conviction. The point is that overall water levels are going up, overall flows are going up, and India will surely be beneficial on that. Some investor within that basket might find India might expensive and might not allocate. But in general, I see a situation that no allocator of the emerging market can ignore India, cannot be underweight India, because India is one of the most promising market from a growth standpoint of view. You cannot see this kind of sustainable growth in any market in the emerging market space, and hence my conviction is that India will receive very large flows.
Got it. I read an article when maybe Vikas Kimani gave an interview to a newspaper which said that if indeed markets are so expensive, why aren't they correcting? And that's true, viewers, that markets aren't quite correcting. Now, Vikas, I want to ask you the contra question as well. Now that India has eclipsed China in the MSCI IMI weightage, and as per Morgan Stanley's note, very soon might eclipse China on the overall weightages as well. Could the converse happen, that everybody is saying that, oh, India might be expensive, or some people are saying, let's say that India might be expensive and therefore flows might be muted. Can the converse happen, that because of India's weightage, we might be surprised by the quantum of foreign flows that come in this easing cycle? Can that happen?
Absolutely. I think we will be surprised. We will have a deluge of money, and in fact, we will have an avalanche of money coming into Indian markets. Now whether timing and pace, I can't really, it could be 1 year, 2 year, 3 years, but, the fact, just imagine, analyze. China is the one market where US investors aren't allocating. There's a huge, this thing happening. which is the large market where you can deploy billions and billions of dollars, with the confidence of growth coming around, and where you have the democracy, when you have the very solid corporate governance system, where you have the growth, where you have, so there's no market. If you ask me, I mean, yes, markets like Indonesia, but how much capital they can absorb? So point is that when money comes, India is a very, very, very large market. And fortunately, the size depth of market is increasing. One side, when people complain about a lot of IPOs and supply coming in, yes, this supply is essential for this absorption of this money which is going to come in. And that is a happy news. That's not a bad news. And the glimpse of this you can see when Japanese economic miracle played out. Lots of investors flocked to Japan. Between 1965 to 1989 was a bull market for Japan. And, initially lots of skepticism was there. But towards the end, in late 70s, late 80s, there was no investor, globally who was not going towards Japan despite being expensive. And Japan, mind you, peaked at 60 times Nikkei. P of Nikkei in 1989. So I think, I'm not making a point that what we will trade, Indian markets will trade, but the point I'm directionally trying to tell you that when the money comes in, it just sort of, in an allocation money, it finds way to a market. And I do believe that, and by the way, one data also one must keep in mind, US as a percentage of the world market cap today is 61%. Last time it peaked at 51%. So how much more money US can absorb, and the fact that the rate cut cycle is beginning, there's also case can be made out that US economy will be soft. Hence, you might not have the same kind of sort of equity story going forward there. So there aren't many equity markets with a good story going around the globe, and hence I see that we all will keep getting surprised with the amount of money flow which will come both from domestics as well as foreigners.
Got it. Because one counter question to the point that you just made. So paper coming in, primary paper coming in is probably welcome because it will absorb so much of liquidity that is sloshing around, both domestic and global, which will come in. But a lot of people point towards how PE exits and founder exits are happening, and whether that's a sign. In the past, that used to be considered a sign, right? Promoter bech raha hai, he knows something more than the street does, therefore go out. But I see people like you as well buying out those large chunks of paper wherein a PE firm which has been there for around exits, or maybe in some cases even the promoter is selling some stake. What do you say about that?
There could be many reasons why people sell, right? A lot of promoters selling could be a reason for people haven't seen this kind of wealth for a long period of time. So when you see this kind of wealth, a part of safety thing triggers in. I think many generational, next generation is not interested. So, many first generation entrepreneurs, second families are selling businesses either to PE or to to markets. So I think it is very much similar to, by the way, what happened in 80s in US. Many businesses. So basically the difference between promoter and management is getting bigger and bigger. Today we have 5-7 companies listed in the markets without promoter. There's no promoter to that. Board run companies. Incrementally, this number will keep going in. Buying business, selling business will become very, very easy, is becoming easy. So this is, you can see this trend happening, playing out exactly how it happened in US. Business will acquire size, scale, tuck-in acquisitions will happen. All those things are, I think, par for the course will happen. Private equity funds sell for, because their life cycle is over, but they are deploying more capital back into the market. It's not that they're net taking away money from market, right? In fact, one newspaper wrote a very interesting thing that, in 2020, promoters sold post-pandemic almost 65,000 worth of equity stocks. Now, go back and do the mark to market of that, whether that was a smart decision or a bad decision. The point is, selling by promoters does not necessarily mean only that it's negative. Of course, you have to look at the situation. You have to look at the company. I'm not making any blanket comment. But yeah, you have to, see India's story in right perspective. According to me, we are in a very, very transformative phase. And you have to, of course, individually analyze individual opportunity, sector management. But we will be creating one of the largest wealth, or as basically 80-90% of India's wealth is yet to be made over the next 20-25 years. So we are in that kind of cycle, and once you have that, then I guess idea is to just remain invested and sit through pains which come and go.
I tell you, viewers, whenever you are slightly more skeptical about the Indian markets, you got to hear Vikas Khemani, not just this interview really. I mean, interview, he's been bullish and constructive for a long time. For now, it's paying off. So keep that in mind. Vikas, where within this whole landscape are you more constructive on? Because different people, I mean, there are many 1,000 ways to skin a cat, but I'm trying to understand how does Vikas Khemani think about this?
So I think, again, India is one of the very widest story in my 25, 30 years of career. I haven't seen so many sectors playing out. You have great opportunities in manufacturing, you have great opportunities in financials, technology, consumption, infrastructure. I mean, it's one of those periods where, things are happening at a great pace and interesting space in every aspect. And this is one of the most widespread balancing growth. You have a domestic consumption story, you have export story, you have manufacturing story, you have services story. So, so this is where I think we are, in my opinion, again, spoiled for choices, that we can pick up what we like, and our focus continues to remain great quality managements in good businesses and at a reasonable valuation. And mind you, I am again telling you, Niraj, you are able to find out, despite no matter what people make the narrative about. To give you an idea, in our Bharat Amrit Kal fund, our portfolio earning growth is 22-23%. ROE of the portfolio is 19-19.5%. Debt to equity is 0.1. PEG ratio is 1.1. So you are able to find reasonably priced. People who make the argument of expensive, I think, are approaching markets from reversion to mean perspective. But that doesn't work in a transformative economy. Reversion to mean works in a steady state economy. But transformative economy, reversion to mean doesn't work. And that's the reason we need to study and understand different markets. And my conviction is that, there are many pockets of opportunities within those segments I spoke about. Each has to find its own comfort and, build portfolios.
Such a valid point in some sense, because just help us understand this better, right? Because you said it's a wide bucket. Where is it that, I'm not asking for stock recommendations here, but where is it that you are more constructive on within this transformative set? I mean, there might be 10 themes that you really like. Tell us about one or two where you believe that things are changing in such a transformative way that the sector earnings will look materially different, let's say 5 years out.
So I think, again, manufacturing we've been speaking about for a very, very long period of time, and
but that's a wide bucket, because sorry, but that's a wide bucket. Because I'm sorry, so narrow it down, yeah.
No, I know, I'm coming to that. So I think that's a very wide basket. But within that, I think, in my opinion, auto components will keep surprising, markets. The great story in place. We will keep seeing it within pharmaceutical. CDMO is a space, I think, is where IT was in mid-90s, and it's a very, very massive 10-20 years story. We'll keep getting surprised on that. Within consumption, by the way, we've been all along negative on consumption and its valuation for last 5 years. Last 3-6 months, we invested heavily. First time we are significantly overweight in the space, but we are able to find reasonably priced, good, high quality in the consumption stories where we can see 15-20% growth coming through. Premiumization is playing out, customer spending is playing out. So you can, within IT, by the way, which is considered a relatively slower sector, I think there are companies which are growing at 18-20% within AR&D space, which is the fastest growing segment in that space. Product-oriented companies, again, are growing very, very well. You can find those companies also in this space. So look, there are pockets of opportunities. We look at broader theme and then go and narrow down within that space what grows faster, what grows delivers better risk reward, and then we look for those kind of ideas.
Got it. Well, Vikas mentioned about how CDMO is at a place where IT was. I want to dwell on a little bit on the present as well, because just stay on, because I need to get in my colleague Rucha to talk about what's ailing IT services today, because from amongst in a very, very flat market per se, Nifty IT is sulking big time in trade today. Rucha, what could the probable reasons be?
Right, so Nifty IT is falling in trade today, and this is largely on the back of one news that came out in Accenture, wherein Accenture is set to delay its staff promotion from June to December. Now, this is the information according to Bloomberg, and Bloomberg reports that Accenture had told its employees in an internal email that they are also considering to permanently shift the promotion cycle from June to December. Now, I'll tell you why will this be happening. Now, clients generally set their budget in December for the coming up calendar year. So if the December cycle comes into the picture with respect to employee promotion, the company gets better clarity with respect to how clients are looking onto their budgets, and then the company can decide onto their expenditure like employees, ESOP costs, etc. So this might be the reason why Accenture is considering to get a better clarity on demand. Now, talking about IT as a whole, well, Citi had come out with a note on Accenture per se, the global team, when it had mentioned that surveys point to relative demand stability. Now, mind you that over the last couple of quarters, demand was into pressure because of different macro uncertainties like war, interest rate, etc. But now the surveys conducted by Citi indicates that there is relative demand stability, if not a dip in demand. Also, clients are, however, cautiously optimistic towards CY25 budget, which means that CY25, that is calendar year 25, will likely be better than calendar year 24. But different events like the federal meeting which we have and the election cycle which is coming up this year could also affect clients' budget, and hence the budget could also affect how much they spend on IT, and hence reflect in the revenue for IT companies. Now, pressure also continues to be on smaller discretionary deals. Now, discretionary happens when clients have to cut out on their budget to accommodate different expenditure as well. So pressure on smaller deals although continues, and budget reprioritization is also happening by clients. But comparatively, like if we stand right now and if we compare IT's outlook back 4 quarters back, we can see that there is relatively better green shoots which even different companies had mentioned in the first quarter earnings.
Yeah, point well noted. Rucha, thanks for bringing that to us, because any thoughts here? You've been constructive IT. There has been a bit of a rally, but some of these rallies get punctured at times by some developments, the latest being Accenture saying that, hey, we'll do the promotions only 6 months out, and some people taking it as a sign of there being continued stress.
No, IT is one of the most closely watched sector, and I think every small item gets used and or analyzed. And I mean, my way of looking is very different. Look, again, while directionally, I think sector is bound to grow. Now you can argue whether it'll grow 8%, 10%, 12%, or anybody's guess. I think NASSCOM has given a great guidance in terms of sector is growing. The only thing is we have to find out within that what offers better risk reward, what sector can grow, right? This year also IT sector has done very well. If you see many IT stocks are up between 50 to 80%. And if you look at last 2 years, many stocks in our portfolio are up between 100% to 300%, right? So, point is that while, of course, very large IT companies will always have a challenge in terms of growing because the base is very large and bit of a internal changes are happening in terms of technology changes, and they are kind of going through that phase. But fact is that directionally it's growing well. We are not negative on IT as a sector, and I have said in the past also that IT is also a good play on Fed interest rates going down, and that has started playing out in the last 6 months. The moment indication of the Fed cutting came down, right? Still, in my opinion, a lot of transformative work in US has not started. A lot of companies were so far spending only bare bone, required money on IT development. But I think the transformative or transformation work is yet to happen, because every company needs to spend more on tech, or needs to spend more on digital technologies. Otherwise, you won't be relevant. And still, there's large, wide opportunities on that. So I think we are constructive on the sector. Now, which company to play and all is a matter of which segment to play is a matter of choice by each of us.
Fair call. That's completely understandable. Vikas, what about other forms of non-manufacturing space? So, for example, BFSI, I know from our previous conversation that you've told me that if India is to grow the way everybody envisages it to, banks are a short presence there. What about non-banking names? We missed that part the last time that we spoke. So, both lending, non-NBFCs, and non-lending financials. How constructive are you? You may be constructive on all, but in the pecking order, do they come lower down in your overall portfolio, or are they right up there?
And we could see some bit of pressure on NIMs coming through, and hence, about 6 months ago, 8 months ago, we had more aligned our portfolio towards non-credit as well as non-bank. So we own fairly large NBFCs in our portfolio, which has done pretty well. We own, non-credit players, life insurance company, which has done again well. So I think we kind of made that, and that does not, mean that we are not bullish on the credit segment, but there's a bit of intermittent, probably 12 months consolidation, 15 months consolidation possible. And hence you kind of adjust your weights towards some of the names which you think can deliver better return in order to generate alpha. Both credit and non-credit are going to do well. I think, if you take 10, 15-year view, whether it is insurance, whether it is wealth plays, whether it is any segment you think we are significantly under-penetrated, and as wealth creation happens, as per capita income goes through, more and more savings get channelized through the same sort of 2 or 3 channels, whether it is capital markets, whether it is insurance companies, whether it is mutual funds. So all of them would be growing reasonably well. We own AMCs because we think that they are structured in a good place from a growth perspective. So all these things I think do us look very, very good. Right now we are a little bit more overweight on non-credit and non-bank plays, but we are not negative per se on banks as well.
Okay, my final question, because I'm not asking you to comment on this one, but at times it becomes my job to ask you about the most spoken about thing, and that is Bajaj Housing Finance, and the fact that as of yesterday, the market cap of that one name eclipsed the market cap of 10 subsequent housing finance names. Is this a sign of exuberance, or is it the market paying premium to a quality franchise?
Bajaj Group obviously is most sort of sought after. They've always been trading at a premium, whether it is NBFC space or this one. I think there's a huge sort of premium for that governance and execution, which well deserved. And Sanjeev is a good friend, so very, very good. We've analyzed that like the franchise. Probably we find valuation slightly expensive at these levels where it is. But to each his own. I would not call it exuberance, but at the same time, I think yes, we have to be careful. There are stocks where there's a lot of exuberance. There are no stocks where you are able to find interesting plays. Market level, I still don't think we are in exuberance mode. Yes, there are pockets of signs, worry, risk are getting developed when you see poor quality companies also going public. Good quality management going public and getting valuation is one aspect, but more worrying aspect to me is poor quality management, poor quality businesses going public and getting good reception. That is my, in fact, bigger worry, where a lot of retail investors lose money permanently, and that is what I will always caution against. In Bajaj Housing kind of cases, you may not make money, but you will not lose money, and that's at least a good part. But so that's where I would say the exuberance should be avoided, and we should be careful.
Okay, because excuse me for making you talk on a stock, but it was not a recommendation. But I just thought I should ask you because it's such a big talk of town. But thank you. Fabulous talking to you today. Thanks for so many insights that you've shared with us today.
Thank you very much. It's always a pleasure talking to you.
Thanks, Vikas. And viewers, thanks for tuning into this edition of The Talking Point.